Credit Suisse and UBS, Tom McKenzie in London.
And here are your top stories. Hand-forced, deal done. UBS will buy Credit Suisse for 3 billion Swiss francs in a government-brokered takeover aimed at stemming a growing crisis of confidence. Wipe out the riskiest Credit Suisse bonds known as AT1s get written down to zero as part of the bank's shotgun sale. Similar securities from UBS to HSBC to SocGen fall. Plus, as the Fed meets this week, it boosts dollar funding with 5 central banks via swap lines to ease strains in the global financial system. Markets swoon with stocks and futures sliding, while treasuries and gold jump.
Now, Tom, European futures pointing to a pretty negative session after UBS agreed to buy Credit Suisse in a government-brokered deal, the deal aimed at containing a crisis of confidence that really had started to spread across global markets. Now, Colin Kelleher, UBS chair, says the deal is ultimately beneficial for the bank.
It's a historic day in Switzerland and a day, frankly, we hoped would not come. I would like to make it clear that while we did not initiate discussions, we believe that this transaction is financially attractive for UBS shareholders, protects UBS from additional downside, and should support earnings growth over time.
Let's check in on the market reaction to this historic deal then. Currently, the FTSE 100 down 0.7%. The banking sector in focus. The decision to write down those AT1 bonds to zero, a significant impact, of course, across the banking sector, and we'll do a deep dive on that throughout the show. Over in Italy, the FTSE 100, the FTSE MIB is currently down 1%. The Spanish IBEX is off by 53 points, down 0.6%. Commodities being crushed as well. Iron ore, look at that, down 3.5%. Brent down 2.7%. Goldman Sachs walking back their call that you're going to get $100 a barrel on oil by the end of the year because of the economic impacts of this global crisis around banks. And of course, it is Fed week. Markets starting to change their pricing for the rate hike coming through from the Federal Reserve. Do they go 25 basis points and wrap it up, of course, in dovish commentary? That's a check on these markets just a couple of minutes into your European Open as we assess the impacts of this significant and historic deal. Francine Lacroix has been on the ground following all the twists and turns. Francine.
Yeah, Tom, thanks so much. We have team coverage actually here in Zurich. Sarah Mannes-Kreiner was holding the fort. I went to the press conference in Bern. I think we were one of the very few international journalists because they kept it quiet. I have to say that press conference, there was everyone. There was the 2 chairmen, Credit Suisse, UBS, the S&B president, the president of Switzerland, the finance minister, and the regulator. Mannes, of course, we were looking. I mean, we're lucky that between us, we did like 6 years of German language. This is what the papers are saying. So really, French paid news left, right, and center. Many questions, not only for bondholders, not only for, I guess, Swiss banks in general, but actually what happens if you have a Swiss bank, universal bank, you wonder whether it's going to be too big for this country.
Well, it certainly got a heck of a lot bigger, didn't it, in the space of 48 hours where they put two beasts of Banhofstrasse together. But what you have here was your question. I mean, you said, we were downstairs and we were just chatting. It was your question at the press conference where you asked about AT1 bonds. And these are the bail-in bonds. And suddenly the question now in the market this morning is, have they inverted the capital structure? Equity still has a value. Bonds, AT1, zero.
I have to say it's a pretty awkward moment in the presser because, again, there were 7 of them. We asked, as Bloomberg, actually, why did you choose to wipe out AT1s but give a big back to shareholders? And there was like a silence for like 10 seconds that felt like an eternity. And then finally it was the FINMA chair that answered that question. I mean, this could have repercussions not only for Swiss banks, but actually all bank bondholders. This morning you wake up, you kind of think, right, if I'm an AT1 bondholder, has it suddenly changed my viability?
It's certainly changed the cost of your capital. These are the calls that I made this morning to Dubai, to London, and to Madrid. The cost of capital for all banks has now risen. AT1s are now really on the hook, so this structurally changes. Now, that's got consequences for the cost of lending, for your car, for your house, for everything. It's also got a potential tightening impact across the European economy. The finance minister on that panel last night, this is not a bailout. This is everything that is a bail-in.
Yeah, so she kept on saying, look, this is a corporate solution with the help from the government. And I have to say, she repeated about 3-4 times. Yes. The other thing that we really need to try and figure out is when you look at some of what UBS actually paid for it, and this is fun being with Manus on air, because Manus has been following UBS for years. I've been following Credit Suisse for years, so I feel like we're also maybe getting married as well. Manus, when you look at how much they paid for it, I mean, was it really that bad? I mean, Credit Suisse, first of all, was a fully capitalized bank. There was no real problem of capital. They just saw off the fate of investors. But you also wonder whether they're seeing something ugly in there, whether it's the investment bank that will, has something toxic that they'll have to unwind because they paid so little for it.
Well, here's the 2 items. One, there's a liquidity lifeline, 100 billion. That is the backstop in terms of depositors, but it's the 9 billion for losses that may come that the government are on the hook for. And this is where Kelleher himself said, look, we don't doubt for a moment that the assets are marked properly in Credit Suisse, but we don't know. When you try to unwind, I take my mind back to RBS in 2008, 2009, and Lehman's, a lot of heavy, big, multi-structured products had to be unwound over a long period of time. And that's where the risk is. When you unwind them, the liquidity is not there to unwind them, so therefore the losses might be bigger than you anticipate, and that is the backstop.
There's actually a quote that stuck to my head from 2008, maybe it must be 2008, with Fred Goodwin of RBS after his meeting with Gordon Brown was like, that wasn't a meeting, it was a drive-by shooting. And you wonder the shock of the leadership of Credit Suisse, given, this happened so quickly. It was like 4 or 5 days, and boom, it was kind of taken over.
Absolutely. I read there was an article, I think Sergio Motti, who ran UBS, who turned UBS around, who we both met on many, many occasions, said, Uli walked into a burning building. The question is, what could he do to turn that around? But here we are. I would say I've lived through a number of mergers. I've lived through mergers of equals. They are in theory. They are not. The lifeblood gets sucked out of you when you're the smaller component. That's First Chicago, Emirates, First Chicago, NBD, Bank One, now JP Morgan. Torture. You get subsumed, and it is hard.
Yeah, I mean, culturally, and this is the other thing. So let's break it down, right? There are 3 things that we really need to find out. The repercussions of wiping out this AT1s at 17 billion, what that means for markets in general. 2, actually, what does this mean for regulation? Are we going to see central banks, like they did yesterday, step in with some kind of coordinated action? And then what does this mean for the bank? So we understand, but again, it's very thin on details at the moment from the UBS chair. They will keep the Swiss bank, the Swiss Universal Bank.
Which is the jewel in the crown, so to speak.
Unclear whether regulators will actually be okay with that, right? Because it means it's big. And then what happens to the investment bank?
Correct. And I think when it comes to the investment bank, this is the CSFB hive-off, which Kelleher gave you some reassuring words on that, I think, in terms of this is a good business. He didn't commit to it completely. Yeah. And this is where you could have the likes of Deutsche Bank, BNP Paribas, SocGen, etc., circling around now to look at other options that are out there. But this is definitely an unequal footing for all. There's huge overlaps in wealth management, asset management. Yeah.
And something that also struck me was actually a memo going out from UBS saying, look, Credit Suisse is still a rival until this completes, so don't share any details with clients. Tom, the markets are opening. What are the 2 share prices doing?
Well, guys, look, you've outlined the challenges and the key questions there for the banking sector and for UBS as it absorbs Credit Suisse. And here's the market reaction then. UBS currently down almost 9%. Clearly, investors in this bank want more clarity, even as they assess the gems, the hidden gems within this deal, whether it is indeed the Swiss bank or the private wealth part of this business. Credit Suisse pricing at the levels that these equity and shareholders have been given as part of this deal, 70 cents on the Swiss franc, down 61, 62%. Yes, that is a shocking drop but not altogether surprising given that we know this is part of the deal for the shareholders of Credit Suisse being given around 70 cents as part of this deal. And again, the AT1 bondholders, as Francine was outlining for us, being wiped out. That is the market move across UBS and Credit Suisse on the back of this historic deal. Let's zoom out and take a look at what's happening at the broader picture. Again, a number of officials from Europe, European officials from within the ECB coming out saying we should be reassured the European banking system is stable. We've heard that from Mr. Villeroy of the Bank of France just in the last hour or so. Across the benchmark, losses of 3.7%. Look, Manus was pointing to the profitability hit potentially and these tighter credit conditions. Those factors being weighed by investors, as is, of course, the holdings around the riskier parts of the bond markets and that write-down of 17 billion when it comes to AT1s. Let's look at some of the individual banks on the move then on the back of this deal, the read across. The capital structures are there. The regulatory system is there. Every single guest we speak to says this is not a Lehman moment for these European banks, but you are seeing losses. Standard Chartered down 6.5%. Deutsche Bank over in Germany down 8.5%. In France, BNP Paribas, again, the Bank of France governor saying French banks are solid, down 5%. Commerzbank in Germany off by 6.5%. Francine, this is a risk-off move. Investors want more certainty, it seems, when it comes to this European banking space.
Yeah, I guess the lesson for that, and maybe they were expecting, is you don't wipe off 17 billion bondholders and AT1s and expect the market to be fine about it. So I'm sure there's money changing hands overall. The one thing, and Manus, we've been covering really blow by blow yesterday about how much they were negotiating. At some point they were going to sell it for 1 billion. Now it's 2 billion. What struck me is that there was also a clause in there at some point that actually they could get out of this deal if the CDS of UBS was up by 100 basis points. Yesterday, we had reassuring words from the UBS chairman saying, like, look, they're committed to this deal, but we don't 100% know what happened to the clause, if it's gone completely or if, something could still happen.
Listen, I got on a plane. The deal on the table was $1 billion. I got off the plane to Prada Place. It was $2 billion. By the time I went to bed last night, it was $3 billion. And this is about the credit default swaps. You need to go back to 2008. I think we've got the credit default swaps chart in the gallery. You need to go back to 2008 to see credit default swaps at UBS.
Yeah.
Up over 300 basis points. That's the risk. The markets will test everything. They'll test the CDS, they'll test the equity, and they don't know what's on the books, in the back books of Credit Suisse. That's potentially why you're seeing a 9% drop in UBS, potentially.
Yeah, and also just the valuation, right? If you look at the 7.4 billion valuation that we had at the close on Friday, and what we're here now, this could also explain some of the moves in other banks. I would point to the fact that it's maybe some of the weaker banks in Europe that could be tested next. Tom, we have plenty more, of course, team coverage throughout the day here from Zurich.
Yeah, really, really excellent coverage, of course, from our experts on UBS and Credit Suisse on the ground for us in Zurich on this momentous moment, of course, for the banking sector. Coming up, billions of dollars worth of risky Credit Suisse bonds are rendered worthless after UBS agrees to buy its Swiss rival. We're going to discuss those so-called AT1 bonds next and the broader implications then from the world of finance as they're written down. We're going to take a deep dive into this historic Credit Suisse deal in our banking breakdown special edition of Surveillance Early Edition, anchored by Francine in Zurich. Stay with us for that. 9 a.m. UK time. This is Bloomberg.
We can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. we believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Our studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
If they did nothing.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Central banks groping their way through a dark room looking for Schrodinger's cat.
Does this indicate that the Fed is petrified?
Does bank supervision take precedence?
If you want to fight inflation, you better sort out your financial system first.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
Welcome back to the Open. We are 15 minutes into the European trading day. Losses across the benchmark of around 1.5%. Futures in the US also lower. Banks and the banking sector here in Europe down more than 5% on the back of this deal, and a significant risk-off mood. Bonds are bid, as is gold. Oil under pressure on the impacts for the broader economy. Now, among the biggest losers in the shotgun sale of Credit Suisse are investors in the firm's riskiest bonds, AT1s. $17 billion of them now rendered worthless, potentially sending that $275 billion market for bank funding into a tailspin. For more, we are joined by Gildas Surrey, partner at Axiom Alternative Investments. Gildas, thank you for joining us. Let's talk then about the preference given to equity holders in Credit Suisse versus bond holders, upending tradition, upending expectations, and yet within these bonds and the prospectuses, it's written in, this could happen. What is the broader implication of the write-down of $17 billion worth of AT1s?
Well, it's a massive shock for the AT1 market, and we haven't assessed, the full ripples of this shock wave. The Credit Suisse AT1s amounted to 13% of the US dollar AT1 market, so 13%, 1-3, it's a lot. So AT1 investors, but also capital structurers who design those products are actually astonished by the treatment over the weekend. The price action we've seen last week was AT1 bondholders standing ready to burden sharing the restructuring of Credit Suisse, with the average price dropping to 28 points of nominal. But the outcome we've seen yesterday at 7:30 was definitely the worst outcome for the asset class. And also, it's a bad outcome for all the other issuers of AT1s in Europe, in the EU in particular, but also in the UK, whereby there's a lot of, I would say, thought and rigor structured into those instruments to make them work throughout the regulatory cycle. And the Swiss finish is definitely an outlier.
Gildas, talk to me a little bit. And so we've been covering, of course, this in Zurich blow by blow. And I have to say there were a number of options on the table, including going to resolution for these two banks, including some kind of government stake, so either full nationalization or part of it. Out of these three options, is still this the best outcome? So not a perfect outcome. It will raise question. Maybe investors will test banks, especially for bondholders, but the best outcome we could have hoped for.
I will not put it that way. I don't think it's the best outcome because, yes, the financial center in Switzerland is protected, but still a number of private wealth investors are actually exposed to those products. Maybe not on Credit Suisse AT1s, but on typically UBS AT1s. I'm thinking in Asia in particular. So I don't think it's the best or the optimal choice that has been taken by FINMA. In the conf call yesterday with UBS, so the management was clear that the decision to write down the AT1s came from FINMA, and that was taken as a given by UBS to step into the deal. FINMA took a very harsh stance on the AT1 investors, and some of them are actually in Switzerland. So I don't think it's the best outcome for financial stability and also the prospect of the financial sector in Switzerland. I think we'll have to get clarification about the way forward for those instruments. And remember, Switzerland and Credit Suisse in particular were the first movers on the asset class. More than 10 years ago, Credit Suisse was amongst the first issuers to issue AT1 bonds. And yeah, this move is definitely unexpected.
Gildas, as we look at across the markets now, and particularly we can look at the broader banking space and then what's happening with UBS. And that stock currently down close to 14%, currently down 13%. And across the broader sector in Europe, you're seeing losses of 6.5%. Investors are saying to us through these market moves that they're not convinced that contagion has been fully addressed by this deal. Are the markets overreacting? Is there further downside to these European banks?
Well, I think you're touching on the right point, which is indeed, market sentiment. And behind the market sentiment turning, you've got definitely a crisis of confidence. Banks are a heavily regulated sector. And what we've seen over the weekend is FINMA actually sidestepping AT1 investors. So they've probably been under the pressure of shareholders, in particular from the Middle East, who joined the capital raised in December to actually give a bit of the value of the deal to equity shareholders. But AT1 bondholders haven't had, given a say in maybe joining also the restructuring effort on Credit Suisse. And yeah, I think the issue on confidence is what is at stake this morning when we see all those moves on stocks, but also on bonds. There is an issue of confidence, and there is an issue of trust with the regulators, because FINMA, if you look at the Credit Suisse slides from Wednesday, the blueprint to intervene and to bail in at the point of non-viability was very clearly laid out by Credit Suisse. And FINMA stood out as a regulator that was easy to read when it came to intervention. And what we've had yesterday is definitely nothing of that. So I think the trust with the regulator need to be built up again.
Okay, Gildas Surrey, partner at Axiom Alternative Investments. Important insights. Thank you very much indeed on the need for additional confidence to come through from regulators and governments for the banking sector. And the banking sector across Europe currently down, those stocks 6%. UBS taking a big hit on the back of this historic deal. Stocks in UBS, that share price down in double digits right now, again, as markets assess that deal, 3 billion Swiss francs, but the implications of having to work through bringing Credit Suisse into the fold. We'll bring you more analysis, of course, on the historic deal between UBS and Credit Suisse Stay with us. This is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
News breaks. No one covers the world like Bloomberg.
This is the biggest issue right now facing Ukraine. Last year was all about weapons. This year to ammunition, as they are facing a potential this spring fresh offensive from Russia.
They are very hopeful that there is going to be a recovery. It's not as bullish as some people were hoping. Obviously, markets today very disappointed with the numbers.
This next president is really going to have to come in quite aggressively to deal with a lot of these economic issues that people are dealing with on a daily basis.
Bloomberg, your global business authority. This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
Welcome back to the Open. We are 25 minutes into the European trading day. You're seeing losses broadly across the European benchmark of 1.5%. Significant risk-off moves. You're seeing that pronounced in the bond markets with yields sharply lower. Let's check in on the US banks pre-market as we continue to assess the fortunes of First Republic Bank. The context is that that stock sold off more than 30% on Friday. There's been a rout, of course, in the stock in the last few weeks. We know that regulators and the government are trying to come up with a formula for First Republic. It's been downgraded twice in 1 week by S&P, called lower by 22%. Across Western Alliance, you're seeing losses there, pre-market again of a little over 4%. When it comes to the big banks, here's the pressure there. The big banks, JP Morgan, of course, they benefited from the inflow of deposits, and they've helped shuffle some of those deposits over to some of the individual regional lenders. Let's check in on Credit Suisse and UBS then on the back of this historic deal. UBS down 15% now. The 81 bonds, of course, in focus as part of that deal. But what it means to bring in Credit Suisse into the UBS group despite the prized possessions around the Swiss bank and private wealth. Plenty more coming up. Stay with us. This is Bloomberg.
if somebody says, I want to be, and a person has an impact on society, what would you recommend that somebody do to train themselves and to work their way up to be somebody that's impactful on society?
Well, I think the first thing you've got to believe in something that you really care about. You know, I've been fortunate that over the course of my career, I've come up with things that have mattered to me, and I've pursued them. You know, the best advice I ever got was from Mike Bloomberg. And he said to me at one point, he said, show me somebody who's never lost, and I'll show you a loser. And I believe that if you believe in something, go after it, take risk. Obviously, they should be smart risks, but they should be around things that you really care about.
So you would see your legacy as being actually target ALS and helping to moderate the impact of ALS, if not curing it.
That's my final legacy. I'm proud of some of the other stuff that I've done as well. Transformation of New York after 9/11. I'm also incredibly proud of a lot of the companies we created at Sidewalk, but I feel like I've done a lot.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup.
This is a 3 as the economic picture does. The OK is getting ready to make a decision.
Welcome back to The Open. We are 30 minutes into the European trading day, and here are your top stories. European bank stocks plunge after UBS agrees to buy Credit Suisse in a government-brokered takeover. Stocks in the two banks fall. European stocks slide. More broadly, the riskiest Credit Suisse bonds, known as AT1s, get written down to 0 as part of the bank's shotgun sale. Plus, as the Fed meets this week, it boosts dollar funding with 5 central banks via swap lines to ease strains in the global financial system. Markets swoon, with stocks and futures sliding, while treasuries and gold jump. Let's go over to Francine on the ground for us in Zurich. She was there, of course, at that historic press conference. Fran, take it away.
Yeah, thank you so much, Tom. We have team coverage. Yesterday we're in Bern, today we're in Zurich on the rooftop, and we have, of course, the experts on the ground, the people that have been breaking news day in, day out from the very beginning, both covering UBS and Credit Suisse. I am delighted to be joined by Marion Hofdefmeyer, really one of the pillars of the newsroom here in Zurich, fielding all difficult questions, especially for me at 4 a.m. before I get on air. Marion, this is incredible, right? 4 days, and actually it's unraveled really quickly. Yesterday we were breaking news about, the money involved. There's a lot of questions, actually, viewers are writing in to understand more about whether UBS could actually pull out of the deal. The share price under significant pressure today. Can they?
They cannot. So yesterday during the government press conference, Chairman of UBS, Colm Kelleher, said there is absolutely no way that they can pull out of this deal. This is absolutely a done deal, so to speak. Of course, there's still the regulatory, usual things that have to do with the closing of a deal.
But so over the weekend, there was talk about this clause, material adverse clause, that if actually their CDSs went 100 basis points above what they were on Friday, then they could pull out. Do we know what happened to that clause?
So that was a negotiating tactic over the weekend. UBS was obviously very concerned about, what they were buying. And because of such a fast time pace with this whole negotiation, they didn't get to do the due diligence they normally would have been able to do. And so hence you get in with this material adverse clause. And what we understand over the weekend is that they sort of loosened that a little bit. Now, when Ralph Hammers was asked on the analyst call late last night at 10 p.m. Zurich time what that exactly meant, he wasn't able to give further details and said, it's a MAC clause. It's a MAC clause. It's standard.
Okay. It's standard. Some of the questions actually, of course, in the markets is, have we put a floor under the saga? If you look at the share price, it seems not. I don't know if the worry is on the AT1s and the fact that bondholders now could be a lot more vulnerable across the board, especially with Swiss banks, or whether they worry that because the UBS needed all these lifelines, loans and guarantees from the government, they see something in Credit Suisse maybe that we missed.
So there's a couple of things happening here. Obviously, the AT1 bondholders being wiped out while equity still getting something is unprecedented and very strange. And so there's a lot of questions around what that means for other banks. And when we look across the industry, when we're looking at bailing capital, what does it mean anymore? Because usually bondholders get something, equity holders do not. So that is definitely something that's going to be playing out over the next couple of days in the markets. What was your second question? Sorry.
So the second question is basically because they have so many loans and guarantees from the Swiss bank, does it mean that they looked under the hood of Credit Suisse and went, ouch, there's something uglier than we thought?
I think it more means they didn't get enough time to look under the hood to really see everything, and so they're a little worried about what they might discover now.
Marion, thank you so much. Marion Hofstadtmeier, they're breaking, of course, a lot of the news here from Zurich office. With that, Tom, I'm going to hand it back to you just to check the share price.
Yeah, Francine, the anxiety continues. We were talking about whether or not this puts a floor under what has been happening in the banking sector. So far, investors' conclusion seems to be not yet. There is still that concern. We know, we've been talking to guests about the volatility that should be expected. Maybe this is a question about squeezed profits going forward, questions about dividends and share buybacks. Here's a look at what's happening then for UBS. Yes, it's got hold of that Swiss bank that's valued at far more than the 3 billion Swiss francs it paid for, the Swiss bank, part of the Credit Suisse business, and then the private wealth business as well. Two jewels in the crown, as they've been described. But working through bringing Credit Suisse into the business is clearly a concern for these investors, and you're seeing a drop there of close to 14% for UBS. Again, to what extent is it going to constrain profitability, at least in the current quarter and the quarters coming ahead? Credit Suisse is down by 63%, a shocking move, but again, not surprising given its price now at the levels that were given to equity holders on the back of this deal. Notably, of course, the Saudis are the largest holder, a little under 10%. HSBC taking a hit down more than 4%. We know that over in Asia, this stock was under pressure, 81s, and the write down to zero, of course, a factor there. BNP Paribas off by 5%, Banco Santander over in Spain, lower by 3.8%, and ING in the Netherlands down by 7.3%. It is another bad day for the banking stocks of Europe, Francine.
Yeah, thank you so much. Let's also bring in Bloomberg's Swiss Bureau Chief, Claudia Meidler. Claudia, thank you for joining us. First of all, if you look at the regulators, so this is the S&B, this is FINMA, I mean, is the feeling here that they did a good job?
Well, that's, I guess, the question that needs to be answered over the next couple of months and so on. But I think, I think certainly there are some people that are raising questions, whether they were there, whether they were actually on the ball the whole time or not. I mean, the head of FINMA, who actually didn't speak at the press conference last night, which seemed a bit surprising, but he's been in charge since November 2021, so not really that long. The finance minister, who I think did a very good job at the press conference, she's been as finance minister in the role for about 2.5 months, so pretty new cast. On the other hand, Thomas Joran, of course, of S&B, he's been around for a very, very long time, decades at the S&B, so he has a lot of experience.
Yeah, and we actually caught up with the FINMA chief executive afterwards to try and get a sense on whether they were speaking and happy with regulators, for example, at the Fed and the BOE. Claudia, if you take a step back, and I know we're in the thick of it, and actually there's, the share price is maybe not doing what UBS would like it to do today, what will be the shock in Switzerland in months to come? I mean, this is it's a very quiet, we're in Zurich, it's a fairly, insulated, quiet country that is very proud of its banking history.
Yeah, it's definitely a shock to the system. I mean, if you look around, the skyline hasn't changed, right? Nothing much really changes in Switzerland. I lived here 25 years ago or so, and I came back and I was like, well, not really that much has changed. Of course, there have been a couple of shocks that they've also had to endure with, like Swiss Air, like back in 2001, and then the UBS situation in 2008. So there were a couple of things, but yeah, this is a total shock. I think people weren't expecting this, and especially how fast it went. If you really think about it, I mean, this kind of all unraveled from Wednesday morning onwards. I had a conversation with someone who's not involved in any of this, and on Friday he said nothing's going to happen. It's all going to be fine. So, and clearly, a lot happened over the weekend, and it wasn't so fine. And now, if you look at the UBS share price down, what was it, I think 7% last I heard. So, yeah,
it's quite something. And actually, we have a lot of viewers also saying, like, look, this is a fully capitalized bank. So exactly what happened, I guess this is like fear on the markets, right, is the fact that once you lose trust in the system and the bank, there's almost no turning back.
Yeah, I think that's one of the key problems here. And as I said yesterday, they did some due diligence. You were at the press conference, right? They said they did some due diligence, but they couldn't do everything yet. And I think that's the fear. And this is also where this government backing comes in, where the government said they would guarantee for any losses that UBS is taking on from Credit Suisse.
Yeah, the credit lines, I mean, they've really locked this down to almost, if anything happens, the government will step in. Thank you so much, our Swiss bureau chief there, Claudia Meidler. Tom, over to you in London.
Yeah, and just getting up to speed on the latest moves around UBS, that stock price currently down 13%, a little over 13%, and across European banking stocks, you're seeing losses of around 4%. Let's bring in Joanna Ford now, partner at law firm Cripps. Joanna, a big focus in this story today is what's happened with these AT1 bonds and the write-down there. Joanna, is there a legal footing for those investors to challenge this decision?
Well, it's certainly, as your previous interviewee said, it's unprecedented. And I think we'll just have to see what happens. I mean, what happens in Switzerland is obviously quite different from what could happen in the UK. We're already seeing class action in the US against Credit Suisse. And I think that investors are certainly, if they were concerned before, they're going to be even more concerned now with what's happened and the value of their investments virtually wiped out.
But Joanna, at the same time, and good morning from Zurich, where it's nice and sunny apart from, I mean, yesterday was like raining. I don't know whether that's had something to do with the deal. But this could be actually the best deal they would have gotten, because if you went to resolution, given the panic on the markets, or you had nationalization, then markets would have been very worried about that. Is that not the case?
Yeah, that's absolutely right. I mean, there's clearly uncertainty, and there's clearly going to be people who are still worried and extremely disappointed. But it's better than the alternative. I mean, the alternatives could have been, like you said, nationalisation, or worst case scenario, some kind of insolvency. And we could have been facing what's been described as a Lehman moment. Things could have gone really, really badly wrong. So this is a better alternative. It's still not great, I think, particularly for employees. They were already talking about significant job losses, and clearly that's only going to be worse with the takeover by UBS.
Joanna, I wonder, when we look at the guarantees that have come through from Switzerland and the liquidity backstop from the Swiss National Bank, is this something of a template that other regulators may be looking at as the concerns about, particularly in the US, regional banks continue?
Quite possibly. I mean, the way in which the Swiss do banking is obviously different from other places in the world, but that kind of cushion and that backdrop to support things if it doesn't work out, I suppose, is one possible solution. It's not what we saw in the UK with the acquisition of Silicon Valley Bank UK by HSBC. HSBC were just prepared to take that on, but there's clearly more uncertainty around the Credit Suisse situation, which is why I think we're seeing the government guarantee there.
Yeah, and Joanna, one aspect actually that we also need to remember is the fact that Switzerland yesterday, and I was there in that press conference, actually changed the law so that UBS shareholders could not vote on this transaction. As a lawyer, do you worry this sets a dangerous precedent? I don't know what the market is most worried about today. Explain, like, if there are three things that UBS and co need to come out and explain the next 3 days, what are they?
Well, they were always going to have to, there just wasn't time to get shareholder approval of this deal. It needed to be done really, really quickly in a matter of, overnight pretty much. And so they were never going to be able to get the kind of shareholder approval that you would need ordinarily for this kind of transaction. So they had to change the law. In the UK, the special resolution regime works in a similar way, so that effectively the government can force through a sale without needing to get that kind of investor approval. So that part of it isn't unprecedented, although clearly there wasn't the legislation in place in Switzerland. They had to change the legislation to allow it to happen.
Joanna, and one more thing Ford, their partner at law firm Cripps. Yeah, go ahead.
Oh, I was just going to say one more thing to remember is that if this had all come crashing down and we were faced with an insolvency situation, then the shareholders would have been completely out of the money anyway and would never have had a say in what had happened. So if we're looking at the alternative, it's not so different from what would have happened there.
All right, Joanna, thank you so much. With that, Tom, we're going to send it back to you in London. Of course, we'll have team coverage throughout the day on this pretty historic Monday after the weekend that was.
Yeah, momentous, and we'll see how the shakeout is playing across these sectors then. Not a big surprise, of course, that financials and banks are taking the biggest hit, but there's been a bit of a turnaround just in the last few minutes across the banking sector. Yes, you're still off by 3.2%, but that compares to the losses of around 5% just around 15 minutes ago. So the sentiment has started, again, relatively and within the context, to turn a little bit across the broader sector. Financial services down 4%, and of course the safety tilt and the haven tilt to the likes of utilities gaining 0.3%. Bonds as well bid and yield down at least around 10-12 basis points at the front end of German bonds, but also across the US Treasury curve. That's the look at sectors. Coming up, $17 billion of Credit Suisse's riskiest bonds now worthless. We're going to bring you more on the ongoing banking turmoil and what that write down to zero for those 81s means longer term for the banking sector. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I try and play that role.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Welcome back to the Open. 46 minutes into your European trading day. Losses across the benchmark of 1%. But the banking sector, yes, it is down 3.6%, but the heavier losses of the session are being paired, at least for now. Futures in the US down by 0.7%. Bonds are bid. Look at the front end of German bonds, 2 years. Currently, yields down 21 basis points. Fran.
Now, among the biggest losers in the shotgun sale of Credit Suisse are 81 investors. $17 billion of the firm's riskiest bonds are now worthless. The question, of course, is will the losses on those Credit Suisse bonds spark higher funding costs for European banks? That's really the one question that we want to answer. With us now, Jochen Fasenheimer, founder and MD of XAIA Investment. Jochen, thank you for joining us. When you look at the wipeout of AT1s, I guess this is a good deal for UBS because it means that it's not liability, gets converted into equity. But what are the broader questions that bondholders in all banks will ask themselves?
Good morning, Francine. Good morning, Tom. So I'm not a legal guy, but it is very obvious that in a situation where funding is crucial for banks, they need to get liquidity on board, and that doesn't help the situation. That's not only true for the Swiss banks, but that's pretty true for all the others. If you look at the whole AT1 market, CoCo market, I mean, they lost dramatically. And I understand that, from the pure size, you save for the Credit Suisse deal, it probably makes sense. But it's not good news for the funding of European banks.
It's not good news for the funding of European banks. What level of comfort, Jochen, can we take from the capitalization of these European banks and their credit profiles?
I mean, I got so many questions regarding, hey, is this Lehman number 2? And so, no, that's not Lehman number 2. But, and there is no fundamental reason or rational reason for a bank run. But unfortunately, bank runs are not very rational. That means we have to look at other business plans, like, especially real estate or banks being very involved in real estate funding. That's a bit tricky. But finally, to be very honest, I do think this is a very good opportunity for investors, as the central banks just make clear that they will do everything, to save financial markets, as they did it so many times in the past.
Jochen, do you own any AT1s in European banks right now? And would you?
No, I do not. But that is not linked to the Credit Suisse case. I simply do not like AT1s, and I do not like CoCos, because, to be very honest, I always have seen the risk that you probably get wiped out completely, while on the equity side, you will get money back. So I was never, ever a friend of these kind of instruments. I do think they are necessary, but they need to change the legal framework of this stuff.
Okay, the need to change the legal framework for AT1s, not touching them at this point. And of course, the view there from Jochen Felsenheimer that we're not facing Lehman 2.0. Currently, you're seeing European stocks, bank stocks off by 3.3%. Jochen Felsenheimer, thank you for those insights, founder and MD at Exea Investment. Let's get the Bloomberg First Word News now with Sam Etienne. Sam.
Good morning. Chinese President Xi Jinping is starting a 3-day visit to Russia, his first trip abroad since securing a third term as leader. Xi says the two nations need to boost two-way trade, increase investment, and step up policy coordination. Russian President Vladimir Putin has called the relationship the cornerstone of regional and global stability. And US regulators are said to be moving towards breaking up Silicon Valley Bank after failing to find a suitable buyer. Our sources say the FDIC wants to sell the failed lender in at least 2 parts. Bids are due by Friday for the so-called bridge bank that the FDIC set up to take receivership of SVB's assets and liabilities. And former US President Donald Trump's claim that he faces imminent arrest is dividing potential rivals. Party leaders, including House Speaker Kevin McCarthy, have offered support, but most of Trump's potential opponents, including Florida Governor Ron DeSantis, have remained silent. Polls suggest Trump is the clear frontrunner for the Republican nomination. That's Global News, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne, and this is Bloomberg. Tom.
Sam Etienne here in London. Thank you very much. Coming up, ECB President Christine Lagarde joins global central bank chiefs in hailing the Swiss government-brokered Credit Suisse sale. We'll have more on the international reaction. That is next. This is Bloomberg.
everybody want to be a consultant. And what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Welcome back to the Open. We are 55 minutes into the European trading day. Losses, of course, pronounced across the banking sector. Credit Suisse leaves one clear winner, but lots of losers. UBS, under CEO Ralph Hamers, will be running a bank with about $5 trillion of invested assets. And that's insulated with government guarantees of over $9 billion on certain losses. Now the losers. First of all, shareholders like its biggest, Saudi National Bank, of course. It's already lost over $1 billion in just 15 weeks. Yes, just 15 weeks. Next are the holders of Credit Suisse's so-called additional Tier 1 bonds, AT1 bonds. Usually, if you hold a bond, you get your money back. But these AT1s are designed to convert into stock at times like these. The Swiss regulator takes a reputational knock too. It's now the first in the world to see a bank deemed systemically important needing to be rescued on its watch. And there is, of course, Credit Suisse First Boston, the investment banking business. It was meant to be spun off under Michael Klein. The former Citigroup investment banking head was already selling his own advisory boutique to Credit Suisse. As part of the deal, all of that is now in question. We're coming to the end of the European market open, but let's cross back out to Zurich, where Francine is standing by. And before we get to Francine, we'll check in on the markets for you, because yes, it's been a remarkable day again for these equity markets and bond markets as they adjust to the news of the momentous decision for UBS to absorb Credit Suisse. That's a look. 0.7% is the drop. UBS down 11%. Credit Suisse tumbling 60%. The losses as we adjust to the news that UBS has taken over Credit Suisse, what it means for AT1s and what it means, of course, for profitability of the banking sector. Francine is in Zurich and has plenty more coming up. Francine.
Yeah, we have special coverage. 3 questions we want to try and answer. The AT1 wipeout, what does it mean for bondholders? Are we now safe? Do we have a safer banking system? And of course, we try and figure out exactly what this deal means for the investment bank and for the Swiss bank.
out of World War II into the 1950s, you mentioned that the Fed had imposed yield curve control, basically to finance the wartime deficit. They were trying to move off of that. These are all sort of familiar themes to anyone in 2022, but why was that difficult for them?
Well, so let's get a sense of scale, right? Mm-hmm. So in 1941, there's about $40 billion worth of treasuries outstanding. In 1945, there's about $240 billion worth of treasuries outstanding. So that's about double the pre-war GDP. If you scale that to 2019 and say, okay, COVID expenditures on the scale of World War II, that's about $40 trillion. And the question is, who's going to buy it? Yeah. And
so what we're dealing with is kind of nothing. We got it.
In that context. And so that's where I guess the analogy breaks down. But it's a very difficult problem, which is who's going to buy the equivalent of $40 trillion today in debt?
The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
This is Bloomberg.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Welcome to the European Market Open, everyone. Well, Bloomberg Surveillance, actually, a minute. Well, what we're focusing on, Bloomberg Surveillance Early Edition, is, of course, from Zurich. We have a full roundup of exactly what happened over the weekend. It's been quite a weekend here in Zurich, and then we were also in Bern a little bit yesterday for that press conference. So let's look at what we see on the markets. I'm here with Manus Krajny, of course, anchor of the Daybreak. We will bring you team coverage to look at Credit Suisse, to look at UBS. So we're seeing quite a lot of pressure on a lot of these stocks as we head into the 9 o'clock hour in London. Let's get straight to Valerie Teitel over in London to look at the market share reaction. Valerie. All right, we'll get to Valerie in a second, but this is what we know about the forced, or the deal. It's been hand-forced. This is what we're seeing across the board. So this is a deal. It was meant to be $1 billion, then it went to $2 billion. Now it's actually $3 billion. What we know and what we don't know is exactly what this means for the future entity. The combined two entities, if you look at, for example, UBS, what they do with the Swiss bank of Credit Suisse, if we look at the investment bank and what that means going forward, many questions still unanswered. We were at the press conference yesterday. I have to say it was pretty incredible. 7 of the most powerful people in Switzerland together in a room in Bern. They tried not to get too much international press. We were lucky to be there. We heard from the Swiss finance minister, and we also heard from the two chairmen of the two banks. So UBS will buy Credit Suisse, 3 billion Swiss francs. Let's look at the market reaction with Valerie Teitel. Hi, Valerie.
Hi, Francine. It's been a busy morning. The one thing that stands out for me is the U.S. two-year yield is rallying down 13 basis points. The market is thinking that this may change. This weekend activity may change the calculus for the Fed. They meet in 3 days. Crude oil also taking a dive, down 2.5%. This was a big recession trade last week. It fell nearly 10% in 3 sessions, and it's continuing to fall this morning. The euro is trading roughly flat. Now, why is that? It's because the safe haven bid is going into gold. Gold is rallying 1.3%, and that follows on a 3.5% rise on the session on Friday. Now, we need to look also in the European credit space. I've got a BTV here that'll show it. European credit is widening, especially when it comes to the high yield market. That high yield CDS index is 73 basis points wider. IG is also widening out 11 basis points. And bank debt, when it comes to CDS there, that is also showing a widening out. All of this is down to the fact that those bondholders are taking losses on those Credit Suisse AT1s.
Valerie, thank you so much. Valerie Teitel in London. So this is the latest. European banking stocks falling as investors digest the news of UBS's takeover of Credit Suisse over the weekend. UBS paying 3 billion francs in an all-share deal, less than half Credit Suisse's value at the close of trading on Friday, while shares plummeting this morning. So the UBS chair, Colm Kelleher, reassured stakeholders on the takeover.
It's a historic day in Switzerland and a day, frankly, we hoped would not come. I would like to make it clear that while we did not initiate discussions, we believe that this transaction is financially attractive for UBS shareholders, protects UBS from additional downside, and should support earnings growth over time.
Now, for more on all of this, we're joined by Bloomberg's Manus Cranny. Manus, of course, we have full team coverage. Manus has been covering UBS for years. I've been also covering Credit Suisse for years. The main questions, bondholders, if you wipe 81s, what does it mean for the future? And of course, you know, in general, can they back away from this deal? Like, was this a good or a bad deal for UBS?
Well, if you take the equity market price reaction in the first instance this morning, one can only conclude a highly negative first take. Down 15% on the open, we're down 9% now. The first take seems to be, what has Credit Suisse got in terms of highly illiquid assets that need to be run off the balance sheet? There is a backstop. We know that. We know there's a $9 billion backstop for losses on those highly illiquid level 3 assets. Kelleher told you that last night in the press conference. But in the first take, people are a bit spooked in terms of, what are you buying? You couldn't have done the appropriate due diligence over the weekend, but you've got a backstop.
Yeah, and so we slightly differ, right, on this approach, because I think actually that given what they have in terms of loans and credit lines and the fact that they wiped out AT1s, I feel like they're prepared for any occasion or whatever they find in Credit Suisse. You think actually there's a lot of pressure on the share price because they could find something ugly. I mean, I know I was told the investment bank, mainly based in London, could have, you know, difficult stuff to wind down. It could even be toxic.
That is a risk. Kelleher, also the chairman at UBS and the new chairman of the new entity, made it very clear to you when he was talking to you on that podium, which is he is confident about how Credit Suisse have treated a lot of the assets, but we wait to see what that is. What you have here is the cost of capital and risk rising across the banking system. That is constrictive. That is a real risk to the real economy. All banks this morning, all major banks this morning are seeing their cost of capital ratchet higher because the AT1s are at risk. They're repricing.
I know, and we're getting a lot of viewer questions, and thank you for all the viewer questions. Please send them, you know, continue sending them. We're trying to get to the bottom of some of the questions you're asking, but the fundamental question is actually, if you wipe out AT1s, and in general, if you look at what happened to Credit Suisse, I mean, they did not have a capital problem. They had a strong capital position last Tuesday, and then suddenly it was, I guess, panic on the markets. It was, you know, deposits, outflows that turned this around very quickly. Like, could it happen to someone else?
Of course it can happen to somebody else. Of course it can happen to somebody else. It's the speed with which the deposits flowed out. That Saudi National Bank interview that we did, which really, it was so febrile. There was already a gusher of money going out of Credit Suisse on a daily basis. And that comment from Saudi National Bank pushed the whole house of cards in terms of liquidity over the edge. And that's what caused this issue. I think what you have this morning in this market is a great deal of uncertainty in bank capital structures. Has this deal inverted the capital structure of bonds to equity?
Manus Cranny, of course, with me here, joint coverage, team coverage in Zurich. Now, we'll have plenty more from Zurich throughout the day. Coming up, Credit Suisse's roughly $17 billion AT1 bonds become worthless, wipe out. UBS takes over its longest Swiss competitor. We speak with Andreas Venditti, von Tobel's head of banks research. He joins us here to discuss that next, and this is Bloomberg.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
After a week of turmoil, what's the Fed's next move?
The job of reducing inflation is not over.
Are they worried about the signal it would send if they did nothing?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Central banks groping their way through a dark room looking for Schrodinger's cat.
Does this indicate that the Fed is petrified?
Does bank supervision take precedence?
If you want to fight inflation, you better sort out your financial system first.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
Welcome back, everyone, to our special coverage of Banking Breakdown. I'm Francine Lacqua here in Zurich looking at Credit Suisse and UBS. Now, Credit Suisse's 16.3 billion Swiss franc AT1 bonds set to be wiped out following the UBS takeover announcement. The riskiest, of course, unsecured notes were introduced after the global financial crisis, designed to absorb shocks when banks start to fail. Now, the write-down would mark the biggest loss yet for Europe's $275 billion AT1 funding market. So to talk us through the consequences, maybe longer term of this, I'm delighted to be joined by Andreas Venditti, Fontobel's head of banks research. Andreas, thank you so much for joining us. First of all, look, the market is not really taking this in their stride. If you look at the UBS stock price, it's down significantly, Credit Suisse as well, but that's a little bit more expected. What do you think the market is worrying about now? I know there are a number of things, but what do you think is number one?
I think the whole crisis is not over yet. And basically this, provides maybe some calm to the market, but clearly, I mean, some fundamental issues remain. And specifically for UBS, it's very clear that, they take on a lot of risk. They have significant protections against that, but the market is not sure, whether that's enough or not.
Right, but if the AT1 wipeout, and I know if you're a bondholder now, you'd wonder whether actually this, could lead to other banks doing the same. But the AT1, are they converting it to UBS equity? So it gives them an extra buffer. Do they not have enough buffer, UBS, given they hadn't had time to do due diligence, to actually, deal with anything really that's thrown at them?
No, that's obviously the hope. That's the 25 billion protections overall will and should be enough. But you know how the market reacts. The market does not know. It's extremely difficult to assess at this point in time. We know that due diligence was just a couple of days, so not really in depth. So a lot of uncertainties remain. Yeah. And at the end, the whole equity story of UBS changes somewhat, even though they say the long-term strategy is unchanged. But over the next 5 years, it's going to be a restructuring case. And that's very different from what UBS was before and for what investors were holding UBS shares.
Andreas, talk to me a little bit about what you think is actually the riskiest parts of Credit Suisse at this point for UBS. Is it the investment bank? Is it the investment bank that's mainly actually booked in the UK?
I think the riskiest part is really the non-core bit. This is partially comprised of very long-dated derivatives, which, not easy to get out, depending also on market conditions and so on. And this is really the part where basically this 9 billion protection also comes into play. Very difficult to assess what really it is, what's going to happen in terms of losses.
Andreas, how do you understand the materially adverse clause? So we heard and we spoke to also the chairman of UBS at the press conference yesterday. He says, look, they're not backing out of the deal. Do you worry that if this gets too ugly, they could back out of the deal? And would that be a good or a bad thing?
Yeah, it's difficult to say, you know, what it means gets worse, you know. But again, I think the 25 billion is already quite a substantial buffer. We don't know the exact size of the non-core portfolio. That's another issue the market has. We know what Credit Suisse earmarked for being exited. UBS clearly wants to expand that. It's much more, they say, majority of the market's business of Credit Suisse, so much more goes into this pot of positions to be run down. But we don't know the exact size yet of that. And so it's difficult to assess whether the 25 billion buffer is really enough. I hope so, but we don't know.
How would you rate the government response, the chief executive's response, and of course the regulator's response? They moved pretty quickly. Is this the best option out of an ugly situation?
Yeah. I mean, I think there were only bad options, really. So I think I prefer this option to a government bailout.
Yeah. Why?
Purely because of governance, kind of political issues and so on, also here. So I prefer this option. However, you know, there were no good options. So government response, yes, it was. I think it was a good one.
Yeah.
You know, pretty quick and yeah.
Andreas, and again, I'm fielding a lot of questions, right, for, you know, viewers that write in or listeners, for, you know, some of our readers that write in saying this was a fully capitalized bank, Credit Suisse. I mean, just last Tuesday, they had, if you looked at the balance, like everything was fine. What happened?
You know, banking is trust. And in my last report that I wrote about Credit Suisse back in January, I basically said without trust, there's no banking. That's exactly a case where really the loss of trust was so extreme that even though, you know, technically you have enough capital and enough liquidity due to the lifeline of Swiss National Bank, basically you are really at risk that this runs out very quickly. And so you had to act immediately.
Andreas, do you think a lot of markets will test other banks now? Is this just the beginning?
That's one risk, but let's hope for the best, right?
Yeah, Andreas, thanks so much for joining us today. Andreas Venditti, Head of Banks Research at Vontobel. Now, we'll have plenty more, of course, from Zurich throughout the day. Coming up, central banks around the world also praise the Swiss authorities for swooping in to save Credit Suisse. So we'll try and unpack what we're expected to hear from Christine Lagarde a little bit later today. This is Bloomberg.
To the world of business. Balance of Power is now live from Bloomberg's Washington headquarters at a new time. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players. Balance of Power, now weekdays at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight, with replays all weekend on Bloomberg Television and Radio.
Welcome back, everyone, to our special coverage of Banking Breakdown. I'm Francine Lacqua here in Zurich. A lot going on today. So first, let's check on the markets. European banks slumping on Credit Suisse. Commodities also taking a hit. Gold rising as a safe haven bid. Now, we're really trying to understand why banks are being slammed so much. Certainly, when you look at UBS, this is not the picture that the leadership of UBS was hoping to see today. Central banks have hailed the rescue of Credit Suisse after it was bought by its rival UBS in a government-brokered deal. Now, in a joint statement, the U.S. Treasury Secretary Janet Yellen and the Fed Chair Jay Powell emphasized the strength of the American banking sector. So let's get straight now to, of course, Maria today, who's also on the ground to take a deal or to take a look at how the deal was received in Europe. Our correspondent is, of course, on the footsteps of Christine Lagarde. So, Maria, what exactly has been the ECB reaction?
Yes, Francine, and we had that statement yesterday night on a Sunday. Obviously, very unusual. If you read between the lines, the message from the European Central Bank is that this deal was the best possible solution to try to reinstate some order in markets. Now, again, the ECB repeating European banks are well regulated, they're well capitalized, they have strong liquidity positions. And on top of that, as you alluded to, this global operation by central banks to enhance liquidity in the market. There was an interesting tweet this morning by Isabel Schnabel, essentially suggesting that the way this is going to work is similar to the pandemic. So the swap lines running now on a daily basis, not a weekly basis. The operations, Francine, as you know, start today and will run until at least the end of April.
Yeah, could we see more concerted action actually from central banks around the world?
Yes, Francine, and it's a very good question. And actually, when you put things in highlight, you almost think, my God, the European Central Bank got lucky with their decision last week, not this week. And remember, there has always been this message, especially from the head of the European Central Bank, that in such a global economy, you need this global coordination. Of course, we know that at the time, 4 days ago, they hiked into what looked like a banking, difficult situation, trouble situation, and the market was able to digest that. But you're seeing how European banks are reacting this morning. It is not a pretty picture. And for Madame Lagarde, once again today, before the European Parliament, it will be an exercise in instilling confidence once again. And just to run you through the choreography, Francine, this is something that was already on the agenda. It is unrelated in so many ways to the UBS deal, but nonetheless, we know that in this parliamentary hearing, it will dominate the entire conversation. It usually lasts for about 2 to 3 hours, so expect a long Q&A from Madame Lagarde.
Maria, thank you so much. Maria Tadeo there on the ground in Brussels. Now let's get back to some of the experts that have been breaking a lot of news on UBS and Credit Suisse over the years. From our bureau here in Zurich is Marion Halfdifmeyer, of course, one of the most plugged-in journalists that we have here in Switzerland. Marion, thank you so much for joining us. I think so. The market is getting slammed, and I think this is the real, actually, story today. If you look at UBS down 9% at the open, is this? So do they worry that actually they're going to find something ugly in the Credit Suisse complex, or is it really because they worry about some of the AT1s and that the fact that they could be next?
So we were getting some of this color over the weekend as we were covering this developing story. There was a bit concern around what exactly they were buying and how fast it was going through. And so with the investment bank, they were a bit worried about what kind of risk lies there. So that's why you get all these protections coming through. Now, of course, there was this material adverse clause that they were negotiating for as well, which had to do with the CDS and how things would be trading in the bond markets today. It's unclear whether that would actually come into play because Colm Kelleher, the chairman, has said they don't have a way to back out of the deal. So
yeah, and that's crucial, right? Because we don't exactly know what this AMC clause is, but at the same time, they said, look, this is pretty standard.
Exactly.
I mean, the AT1 that is wiped out, that $17 billion, does it directly go into equity at UBS? So this is basically capital that can buffer them from anything that they find at Credit Suisse.
This is a capital bail-in, right? Exactly. So regulators wanted this as part of this privately negotiated deal, so to speak, where they would immediately have a capital injection through the AT1s, but also then have the equity shareholders of Credit Suisse participate going forward as well. So it does help buffer, and then they've also got the added guarantees on top of that.
So what's the riskiest thing that actually there's in Credit Suisse right now? Is it the investment bank booked in London?
You know, that's a question that they'll be looking at very closely. I think that the riskiest things they have identified already is some of these longer dated securities that Credit Suisse has had under what's so-called level 3 assets. So they're slightly more illiquid assets. They're things that banks hold that are hard to value at market price. And so there's a good risk there that they have to mark a lot of things down and therefore bake in some losses.
Mary, I mean, just 7 days ago, we were kind of going around our business. You were, breaking news on the banks, but it's incredible how quickly this had to come at the forefront. Is there a sense that they did the right thing because there was no more time? Again, I'm at pains at always reminding viewers because we get a lot of questions from them. This was a fully capitalized bank. Like, what went wrong?
This was exactly, Francine. I mean, 5 days ago, we were talking about a bank that was still, technically solid. But the thing is, it does give us an example of what happens when a bank's liquidity and particularly deposits start to be called into question. You can have all the capital in the world, you can have all the business in the world, you can have all those ratios, meet regulatory requirements, but as soon as your deposits start having issues, that's when this emergency situation came out, and that's what we saw happen this 5 days, and that's why it was so accelerated.
So are banks around the world, in Switzerland and Europe, now trying to make sure that their deposits are safe by even offering a better interest rate? I mean, does it change the model in which some of these banks, book revenue going forward?
I think a lot of banks are going to be looking at this as a case study for sure. I'm not sure we're seeing that baked in yet today, but going forward, it's going to be something we watch. I mean, Silicon Valley is the same example, right? It was all about deposits, and so going forward, it's going to be a key metric I think people will watch.
Marion, through your great reporting throughout the years, what are you going to watch for next? So is it trying to get to the bottom of the risky assets in Credit Suisse, or what happens to the Swiss bank?
I mean, there's a couple factors here. I mean, we're still trying to figure out what this combined giant monster is going to look like. So yeah, definitely what's going to be happening to the investment bank. But more importantly, because that's sort of in the past, more importantly is what's this wealth business going to look like? Because that's UBS's go-to strategy, and there's a lot of overlap, particularly in Asia, which is the growth market.
Yeah, and job losses, right? I know you mentioned it in one of your great stories, but actually we did not have a head-on response from UBS yesterday on how many job losses. The chairman just said it's just too soon. Coming up, we'll have plenty more, of course, on UBS and Credit Suisse live from Zurich. This is Bloomberg.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
UBS will buy Credit Suisse for 3 billion Swiss francs in a government-brokered takeover aimed at stemming a growing crisis of confidence. European stocks slide. The riskiest Credit Suisse bonds, known as AT1s, get written down to zero as part of the bank's shotgun sale. Plus, as the Fed meets this week, it boosts dollar funding with 5 central banks via swap lines to ease strains in the global financial system. Markets swoon, stocks and futures sliding, treasuries and gold jump. Well, good morning, everyone. Welcome back to our special coverage of the takeover of Credit Suisse by rival UBS. I'm Francine Lacqua here in Zurich. We have team coverage live on the ground, continuing, of course, with this story. Manus Krajny is with me. He's been covering UBS for many, many years. We're trying to figure out not only the implications for AT1s, but exactly, Manus, what we're seeing across the board. If you look at UBS, down 9%, and I think the share price is now maybe down 8%. I mean, there's a lot of questions on whether they have enough loans, enough buffer to deal with whatever thing they find in Credit Suisse. And then the other question is, of course, what happens to AT1 bondholders and other banks?
I think it's the AT1 question that you asked last night that has literally shook the market to its holy core today, which is they've upended the capital structure. We need more detail to understand that. In other words, normally equity gets wiped out. That's what happened in previous bail-ins. Here we are. Equity gets a morsel, just a morsel. But the pension funds here of Switzerland, the people of Switzerland are what's critically important here in the messaging last night in the news conference. They get a morsel. AT1 bondholders, zero. And that goes, we're debating this. Does that go straight onto the balance sheet of the new entity?
Okay. It goes into equity, so that's capital for UBS.
That's capital, but there are the known unknowns and the unknown unknowns. And the unknown unknowns, they are what's inside Credit Suisse, the investment bank, and how long does it take you to get rid of the assets you don't want?
Yeah, we're very pleased to welcome Martin Gilbert, the chairman of AssetCo. Martin, thank you for joining us. Many questions there if you're an AT1 bondholder. But out of the very bad options that the government, regulators, and these two banks had, is this the best one?
Yeah, undoubtedly. I mean, it was pretty obvious probably from Wednesday last week that this was going to be the best option for Credit Suisse.
So what are the questions that you're trying to figure out, Martin? First of all, I mean, AT1 bondholders wiped out. Was it the only way to give UBS that extra capital, or could they have done it without freaking out bondholders across the board?
That's a good question. I think it's brought home to the holders of AT1 bonds what a weak position they're in the case like this of government intervention. So I think it was a good safety net for UBS. I actually think in the medium term this is a pretty good deal for for UBS, and the global banking system. Yeah, obviously if you're an AT1 bondholder, you're going to feel a bit aggrieved, but it is in the terms of conditions that in the event of government intervention, you can be wiped out. I think it's probably one of the few times I've ever seen where they've ranked behind the ordinary shareholders. So that is definitely a new phenomenon for AT1 bondholders.
And I think that's possibly what has spooked the market this morning across Europe. Martin, good to see you this morning. Here's the question. You've put institutions together. You're the chairman of a digital bank. You've chaired and run Aberdeen Standard, a combined entity. What does Ralph Hammers, the CEO, and the chairman, Kelleher, now need to do, I don't know, to bolster faith in this deal? What would you do? What would you say to them right now that you've lived through and they need to do?
I think there are two very big positives to the deal. One is the strength it gives them in the domestic banking market. The second is they're now clearly the market leader in wealth management globally. I think where the challenge is reducing the size of the balance sheets, the combined balance sheets in the investment bank. So if I was them, I would be concentrating on the two positives, and definitely concentrating on reducing the size of the balance sheet of the combined banks.
Part of the reason why you own UBS is because of the monster buyback. Fran and I have covered this several times. She goes to one that virtually hasn't got a dividend. I go to one that's got a $5 billion buyback program. Is that the market risk, that at some juncture the buyback and the dividend come under scrutiny at UBS because of this merger? Is that a prescient market risk?
I think capital is not an issue here. I mean, they bought whatever it is, a huge amount of capital for $3 billion. So I think capital's fine. It always comes down to liquidity, and as long as liquidity is still holding up, they will be able to afford the dividend and buyback. There is an argument that actually this improves their capital position dramatically. But as I say, the big risk is the size of the combined balance sheet and how quickly you can get that down.
How quickly, Martin, do they need to do that to reassure the markets? And again, is there worry that actually they find things on there that will spook markets even more? Like, are you a buyer of European banks, either equity or bonds right now?
Yeah, definitely. I think European banks are in the safest position they've been in. That's as a whole. There is obviously risk with some individual banks. You know, it is a sort of hunt and seek market at the moment. So people will be focusing on what could be the next bank that is in difficulty. But generally, the banks are in as good a position as they've been. They've got this fantastic wind behind them of deposits, which are now lending out at a higher rate. So banks' P&Ls have been transformed. The risk, though, is what is in the balance sheets. But to be fair to Credit Suisse, they've gone down a long way of cleaning up their asset side of their balance sheet. So I think if you take a medium-term view as opposed to today or next week or the next couple of months, this is actually a pretty good deal for UBS to buy this level of capital and now to completely dominate the world of wealth management with the numbers 1 and whatever 2 in the world, and the domestic strength they're going to have now, which they'll be able to rival Raiffeisen in the domestic market.
They might even bring it down to a level of where I can get a bank account, but hey, you know, we can all wait for that. So you're hunting. You say it's time to hunt.
I can get you one at Revolut anytime you want.
You can get me one at Revolut. That's great.
That's a whole other
conversation. Here's what I want to know from you. You say now's the time to hunt and be discerning. Do you hunt in equity? Would you be brave enough to buy equity, or do you think distressed bonds? Gundlach says get your big boy pants on. Would you get your big boy pants on and buy buy CoCos, buy distressed debt that's imploding today? Is that a big roll of the dice?
I would buy the equity. I think this has shown that that's where the value is in equities. So certainly, for me, it would be buying the equities.
All right, thank you so much for joining us. Martin Gilbert there, Asset Co-Chairman, of course, Manus Cranny. With me, Team Effort. We're live in Zurich throughout the day. Now, European banks, of course, trading deep in the red this morning after this historic UBS Credit Suisse deal brokered by Swiss regulators. So who's the biggest culprit for the downfall of this 167-year-old bank? We discuss that next, and this is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes, yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Welcome back, everyone, to our special coverage of the takeover of Credit Suisse by rival UBS. I'm Francine Lacqua here in Zurich. We have team coverage from the ground. Now, also to our editor-in-chief, who knows a banking crisis or two for many years covering them. He is our John Micklethwaite. John, if you look, first of all, thank you so much for joining us. It's good to have a cool, level-headed person to try and figure out exactly what's going on, especially as UBS is getting slammed today. We haven't seen a merger like this, a takeover like this of two big banks since 2008. What are the parallels?
Well, just having seen Martin Gilbert come out as I came on, I'm in one of the kind of greats of Scottish finance. Last week I was up in Edinburgh and we had an event at a new museum called the Library of Mistakes. It's really the Library of Financial Mistakes. And in many ways, it's like a rather brief history of my career as a financial journalist. You have mementos from Royal Bank of Scotland. You have Nick Leeson's signed shirts. And when I began as a sort of financial journalist at the end of the 1980s, the idea that Credit Suisse would end up in that seems rather bizarre. But it is, from that point of view, it is momentous. It's one of those things that we always assumed was very solid. Back then, we had an earlier version of Credit Suisse versus Boston, which was a bit more exciting. But the underlying idea that something as solid as Swiss as that would run into trouble was very different.
Yeah, and this was a fully capitalized bank up until a couple of days ago. So we look at the speed at which this went. Is this your main concern, John, or the fact that how quickly they had to find the solution, which, as imperfect as it is, many are saying it was the only option?
what's interesting, you look at it, the balance sheet doesn't seem to have been the problem. It's all to do with liquidity. You look at the kind of reserves they were asked to keep by the Swiss bank against sort of bad stuff, so to speak. That wasn't a problem. But this one, perhaps much more than back in 2008, has been driven really by liquidity, by people wanting to get their cash back. And that actually, from one perspective, is slightly more worrying for the markets, because what it shows is that even if you think your numbers are fairly good, even if you think the assets you hold are pretty good, if you run into that degree of liquidity call, then that could hit other people as well. And on top of that, you've had this issue about which kind of bonds will be paid in full. And all those things, I think, cause panic. Again, you know, if you go back to that library of financial mistakes, you look around the walls, you see all this evidence of people who thought they were fine. Northern Rock thought they were fine. Lehman Brothers, even a kind of year before, seemed safe as houses, quote unquote. There are so many different ways in which financial firms, when it starts going wrong, could be upended.
So, John, do these big takeovers ever work? I'm also reminded of the quote, the famous, quote from Fred Goodwin, Fred the Shred, at the time RBS, after having met with Gordon Brown, and he said that wasn't a meeting, it was a drive-by shooting. Would Credit Suisse leadership feel the same way?
Credit Suisse leadership might well feel the same way if you think of the way in which their arch rivals have managed to buy them for a fraction of what they were worth even a couple of weeks ago. So from that perspective, having had friends who worked at Credit Suisse for a long time, I think it is a kind of humiliating exit. On the other hand, from UBS, you are buying this pack, and you don't know fully what all the cards are in it. And you also don't know the different ways in which regulators in the long term will treat those cards. And on top of that, so they are taking on a bit of risk, but it could be one of those things where you look back and think that was a phenomenally good deal. If you look back throughout the last crisis, there were some deals which were pretty bad, but there were other ones where people snapped up things incredibly cheaply.
John, when you look at all the financial mistakes that you laid out in some of these other big banks that frankly went under in a rather unceremonial way, is there anything that Credit Suisse could have done to avoid this?
Well, I think the simplest thing would be to stop making errors. I mean, that if you look at the history, we have a very good short video on Bloomberg's website at the moment, which just in about 2-3 minutes goes through all the different problems, Archegos, the various things in Mozambique, these different bits where they kept on being ensnared in every available problem that came along. The only other European bank which seems to have a record somewhat close to that is Deutsche recently. If you keep on that pattern, whenever things went wrong, people started to look to see where Credit Suisse was involved. In the same way, in a different era, we used to look at the German Landesbank and places like that, because you just had a telling that if something was going wrong, they might be somehow involved in it. And I think that is the pattern. So the main thing you can do is just pull out of the slightly dodgy stuff where you're trying to make the margin, and that I think has been the problem throughout this story.
Is this opening a can of worms, given how hastily this deal was put together, some of the questions about bondholders? Do you worry about European banks and the stability of the system?
I think the one bit where you look at the deal, there are two sets of issues. Number one is for the UBS sort of purchasers. The issue there is what exactly have they got? They could well have got one of the great bargains of all time. Certainly when I started in this business, the idea that you could buy Credit Suisse for that little, with that bigger name. And you look back at previous crises, you would be reminded that banks like Citibank had a terribly rough time during the last financial crisis. Now people happily take deposits to them without thinking at all. That it might be just like that this is actually a fantastic deal where they could bring in a lot of things. But there is definitely big question marks like that for UBS. The broader question is for bondholders who've now had some surprises about what exactly was paid out in full and what isn't.
When you put the two big banks, again, endemically, systemically important banks, what would you worry about the most, John? Is it, culture fit? If you look at the leadership at UBS, what will be their main challenge? I guess apart from unwinding some of the risky investment bank, but what's the biggest challenge aside from that, from combining these two?
The biggest challenge always with banks, it comes down to two things. One is culture and people, and the other is the actual assets that you've got, the structure of where you've got, where the mismatches are, where the individual little bits go. In principle, you know, Credit Suisse has got a lot of good people. UBS has got a lot of people. You could pick and choose, and you could make that work. But on top of that, you have this asset question. You know, the smaller things, which they should be smaller, things like property and all those sort of things. Those are areas where you might see easier synergies, I would guess.
John, as always, thank you so much. John Micklethwaite, our editor-in-chief of Bloomberg News, of course, looking at banking crises since the 1990s. Now, coming up, more on the historic deal between UBS and Credit Suisse. We're live here in Zurich. We speak to Klaus Wellershoff, former UBS chief economist, now chairman of Wellershoff and Partners. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
We were speaking very closely with key regulators, those that are most relevant for Credit Suisse Group and for UBS, notably, or most importantly, the ones in the US and the UK. They were deeply involved, and you have seen today their support for this solution as well, their strong support for this solution in the sense of, or with the purpose of financial stability.
Chief Executive Officer of the Swiss financial regulator FINMA there on the backing of US and UK regulators for the UBS Credit Suisse deal. Now, we're staying, of course, on this story. We've been covering all morning that historic deal between UBS and Credit Suisse. Let's get straight to our next guest. He is Klaus Wellershoff, chairman of Wellershoff Partners and former UBS chief economist. Klaus, thank you for joining us. We're just getting a bit of breaking news out of the terminal, of course, out of London. European regulators have reiterated that the CET1 should should take losses before AT1 debt. Are you worried about how this deal was put together and the fact that AT1s were wiped out?
I think it was a very, very hastened deal. Probably there is an issue of completeness and thoroughness here, which is worrying for financial markets today, and I go along with that.
But so, Klaus, what exactly do you worry about the most? So there's two schools of thoughts, right? Saying, look, we had to wipe out the AT1s. That goes into equity at UBS because no matter what they find in Credit Suisse, especially in the investment bank, UBS will be solid. The other one is actually UBS tried to preserve itself, but the unintended consequences on the European banking system because of wiping out AT1s could be concerned. What do you think is the truth?
I think it's a bit of both, and there is a wider discussion already starting in this country, which is about the legality of the whole move. So I fear we've got ourselves into a mess. And if you look at the reaction of investors in this country to this news, it's also not positive. So there are systemic risks that you are alluding to, but there are also liquidity risk at the moment.
Klaus, do you worry about the future of UBS going forward? I was told by an investor yesterday, if you mix blue with vanilla, you never get back vanilla.
I think it is a real concern that people are having at this stage. And mainly that is the combination of the two banks creates a new institution, which is even bigger. And it was already a very, very difficult move to isolate the issues that Credit Suisse had, and the fact that this might spill over, or the expectation that this might spill over, is something that we have to take very seriously. At the same time, UBS is a very different animal. It's a very process-driven bank. If you look into it, it's very well capitalized and it's managed much better than the Credit Suisse. So I'm reasonably confident that things will hold, at least this time.
Yeah, and Klaus, I guess, what were the other options? I mean, yesterday we were talking about possible resolution or even government intervention in the form of nationalization of the whole bank or a stake, and that would have wiped out shareholders. So is this the best solution out of, three pretty bad options?
I think it was the best solution available yesterday, with a little bit more presence. I think we would have had other options, but they were no longer available yesterday.
All right, Klaus, thank you so much for joining us today. Klaus Wellershoff there, the chairman of Wellershoff and Partners and former UBS chief economist. That's it for our banking special. A couple of the questions that we need still to answer is, of course, we heard from the chairman direct. I was at the press conference in Bern yesterday, the chairman of UBS saying he will not back out of this deal. But of course, there's a lot of questions about whether there are clauses if UBS takes a hit too much. The second question is, what does UBS find in Credit Suisse, especially some of the very difficult things to unwind in the investment bank. European banks slumping this morning, of course, on Credit Suisse. We look also at commodities taking a hit, gold rising as a safe haven bid. So we have a lot of questions on the markets, what it means for bondholders, what it means for AT1 bondholders in other European banks, but we'll look at it through the lens of the market, because if the market stabilizes, that's one thing. If we see further losses on the markets, that's a whole other story. Bloomberg surveillance continues in the next hour. This is Bloomberg.
every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live, and it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
That a swift and stabilizing solution was absolutely necessary. This solution is the takeover of Credit Suisse by UBS.
This was not the best solution, but it dominated the other two, which was either nationalization or trying to wind down the bank.
The banking sector, it runs on confidence. We just need to see what the sentiment is out there.
The system is very fragile in the banking system, right? Companies are levered. I think they're well managed, but when things get exposed or moved, it moves quickly.
For sure, it's going to bring down inflationary pressures. I'm anxious to see what the Fed does on Wednesday.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Did you enjoy the weekend? It's like we never left. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz. I'm Jonathan Farrow. Tom Keene is away this week. Equity futures just about unchanged on the S&P 500. UBS, after securing a deal with Credit Suisse for 3 billion Swiss. Lisa, that stock is down by 8% in Swiss trading.
You asked yesterday, would this be enough? Would this be enough to shore up confidence in European banks? Would this be enough to shore up confidence just more broadly that officials have whatever is going on in the banking system contained? And it seems like the preliminary answer is no, not yet, at least in terms of risk aversion.
The other thing I asked yesterday is whether we'd found a solution or created a monster. Have we created a monster?
Well, again, is this a question of the monster of risk aversion? What do the regulators know that we don't in terms of why they're taking such bold action so quickly? Or is this the monster of moral hazard, of questions around what instruments actually do? I'm talking about the contingent convertible bonds that have been wiped out of the Credit Suisse deal, but also this question of the bailout mechanism of a lot of federal officials that had previously said that would never happen again.
Let me give you two takes. This from KBW. They've cut UBS and they say this. Considerable uncertainty around the earnings trajectory. That's one take. Here's the more constructive view. Comes from the team at Bank of America. They say the logic of the deal is, quote, impeccable, and the cost synergies, Lisa, could be, quote, substantial. That's the constructive view of this UBS Credit Suisse tie-up.
A lot of people are saying that this is going to be a very positive thing and it's a good deal for UBS, especially given that they've got a backstop, they've gotten liquidity lines, they've gotten a whole number of guarantees from the Swiss government. That said, there is a question about UBS's reliable stream of income in the way that they previously had. What do you do when you bring in an unknown and then try to integrate it over 3 to 4 years?
There's so much we don't know about this tie-up and about this situation currently. Here's a flavour of the price action for you. In the equity market on the S&P 500, equity futures on the S&P just slightly negative, down about 0.2%. In the bond market, we have been saying for about a week now that this market is screaming you're done to the Federal Reserve. The two-year yield, Lisa, down another 10 basis points. Your yield this morning, 373.
So I'm going to do a different kind of look ahead this morning as really front focus. The only thing that we're looking at, central bankers' response to what's going on in the markets and what's going on to risk appetite, as well as what's going on with the banking sector. At 10 a.m., ECB President Christine Lagarde can speak to both of those issues. She's speaking before the EP Committee on Economic and Monetary Affairs. What does she say now? Did she feel confident about her decision to raise rates by 50 basis points last week? Is she coming in with some alternative measures to try to shore up confidence in the banking system? We'll also get a view from a host of amazing guests this morning. We really have an incredible lineup. Bruce Kasman of JP Morgan, chief economist there. Bill Dudley, former head of the New York Fed. Michael Arrighetti, co-founder, chief executive officer, and president of Ares Management. And Leon Cooperman of Omega Advisors, weighing in on how they see this shaking out, credit conditions tightening, the read-through to the markets. And this, of course, sets the stage. You mentioned the Fed. What does Jay Powell do? Tuesday and Wednesday, the meeting, Wednesday, the rate decision. Right now, the market is saying, as you said, you're done. You're seeing right now the question, not do they raise rates, but do they cut rates, and how quickly?
They've got to put out some forecasts.
Do they?
Good luck to them. Yeah. Well, they can take the playbook, a leaf out of the playbook back in the pandemic and not publish them at all. Or they can get a jug of freezing cold water and just pour it all over them and say, we've got no idea. The ECB has basically put out some forecasts as well in the last week, and everyone's running around saying the following. You'll hear this a lot. If the baseline holds, we might have to do more. But if the baseline holds, it's a pretty big if, isn't it?
Did anyone even look at the ECB's projections or take them seriously?
No.
Exactly.
I don't even remember them.
Exactly. And I think what the Fed could do is just hold them where they are, and then everybody ignores them, and then they carry on without making a statement one way or another on that front.
One name to watch as well, First Republic in the pre-market. So 11 US banks last week come together, deposit $30 billion into this institution. Friday at the close, down more than 30% this morning, Lisa, down another 15 in pre-market trading.
And this comes after S&P downgraded them yet again because of the concern about flight of depositors. Again, you asked this question yesterday. What will it take to shore up confidence in regional banks? Right now, we haven't seen it.
Not much confidence there. The lead story over the weekend, as I'm sure by now you know, is Credit Suisse and UBS, a tie-up worth 3 billion Swiss francs. UBS buying its long-time rival. On top of the story, Bloomberg's Francine Lacqua in Zurich. Francine, so many questions still. What stands out for you?
Hi, John. So I think what stands out is actually we need to try and figure out, we know that the AT1 wipeout is going to cause ripple effects across the board, but that will also be used for equity for UBS. So given the credit lines, given the loans, and actually given the fresh capital that they have in terms of the AT1s, is that enough for UBS as a bank, the biggest bank in Switzerland, if this goes through, to deal with anything that they find within Credit Suisse? Now, we have been told, of course, that it's the investment bank that could be problematic. A lot of the bookings in terms of if there's anything toxic, or even if there's not toxics, the unwinding of some of the COCOs that Credit Suisse has, especially in London, will be, costly and could be time-consuming, especially in the market turmoil. So, first of all, is UBS strong enough to withstand? And then we just look at market share price reaction and bond reaction on the back of that AT1 wipeout. We've never seen anything like it. This was a decision that maybe was the best out of 3 very bad decisions, but it could prove to be a mistake.
Francine, how much pushback has there been about the fact that certain equity investors received something even though these particular bondholders got wiped out?
Well, this is really what we're trying to get to the bottom of. Now, I asked yesterday, I had 7 of the most powerful people in Switzerland in a panel. The 2 chairmen, Credit Suisse, UBS, we had the S&B president, we had the FINMA regulator, the Swiss finance minister, and that's exactly what we asked. Like, what was the reasoning in wiping out AT1s, and what was the reason in giving back to a bit of shareholders? Now, they basically said, look, this is risky assets, so that's how they decided to do. But again, is this the only way that UBS has enough capital to deal with anything else? And what does the market reaction in the next couple of days give us about bondholders being confident or not that this could happen to any bank? Remember, this went so quickly, Lisa, right? 6 days ago, we had an interview with the Credit Suisse chief executive. They were at a record low, but they were fully capitalized. So it's really a market of confidence. When you lose control and actually market confidence drops and leads to deposits, like, what are your options and what are the options for bondholders? That's some of the questions that markets will want to know about about other banks across the world.
Hey, Fran, I've said it a few times over the last week. Tremendous reporting on this story. Francine Lacqua there from Zurich on the latest. UBS down about 7%, recovering. It was down a lot more than that. Looking across the European bank complex at the moment, ING down 4.5%. SocGen down about 3.5%. Deutsche Bank down about 3%. No real drama there just yet. We'll stay on top of that story for you. Joining us now is Max Kettner, Chief Multi-Asset Strategist over at HSBC. Max, I've asked this question a few times in the last 24 hours. It's your turn. Are you feeling more or less confident after that tie-up yesterday?
I feel probably more confident. I feel also more confident after what's happened last week. I would feel much more concerned if indeed if we had perhaps sentiment and positioning much less really downbeat. Now, you know, I've been listening to your show for the last eight minutes, and there's not been a lot of positives yet, right? And I think that's a fair understatement if I say that. And that's the good thing. The good thing is when we look at survey-based sentiment, that's pretty depressed already. If we look at technicals, right? So like relative strength across risk assets, already very depressed. VIX term structure is sort of down to below the 10th percentile already, right? When we look at equity betas of multi-asset funds, down, right? When we look at put-call ratios, not only in equities, but across the asset classes, sending clear bearish risk sentiment signals. So the good thing is, right, with all what's been happening, not only in the last 24 hours, but really over the last week, is that sentiment has gone and has derated sufficiently really to bearish levels that I'd be very careful to throw in the towel on constructive views now, right? So we've just put out a note and said, look, we're still holding on to that constructive view because indeed the sentiment and positioning really across the board looks much more negative now, which is a contrarian positive signal.
Max, let's put a bit more specifics around this. Are you saying right now you're going out there and buying European banks to move counter to the zeitgeist that we see out there?
Yeah, I think so. I think banks are more and more looking actually attractive. If we look at, you know, if we look at the relative performance perhaps of banks over the broader market, look at the performance of banks over tech, for example, that is back to the COVID highs, right? That's back to where we were at sort of the dizzy heights in 2020 when, you know, real rates were down to almost record negative levels. When we look at the broader banks' performance, not only in Europe, but also in the US, when we look at that against, you know, US Treasury yields, if we look at that against financial conditions in particular, it's priced right now for the second sharpest deterioration in financial conditions already, right? So there is an awful lot in the price, particularly from a relative perspective already, right? So I wouldn't say, oh, nothing's happened yet, and, you know, there's much more deeper pain to come. We're getting pretty close to pretty attractive entry levels, I think.
Let's talk monetary policy. Bob Michael sat in that chair yesterday evening from JP Morgan. He said first cut comes in September. Andrew Hollenhorst, the City, published this morning. He said you'll get a hike at that meeting in a couple of days. He said in the SEP, the projections they offer for the dot plot, the median dot for 23, he thinks 525 to 550. Max, what are you looking for this Wednesday?
I think, you know what, John? I think there's one rule right now. Don't overdo things, right? Don't talk too much. Don't change too much. What you read right now, particularly from policymakers, is steady hand, steady ship, right? What you really want is basically a 25 basis point hike. I agree with what Lisa said before. Has anyone really looked at the projections from the ECB last week? Not really, right? Because they've been only marginally changed, really. That's what you need from the Fed as well, right? You don't need overaction, right? You don't need too much. What I would do is, what I'm really waiting for is a 25 basis point hike, not too much change, not too much flip-flopping around in projections or opinions or hiking or lowering the dots, but really steady hand, steady ship, saying, look, we've managed to contain it so far. We can press ahead with the inflation fight. We don't need to be as aggressive anymore as we've been a couple of months ago. Let's see this through. I think that is, if we think about it and we talk about restoring confidence, the number one rule in restoring confidence is steady hand, steady ship, don't overdo it.
Hey, Max, wonderful to get your thoughts, as always, to kick off the week. Max Kettner there of HSBC. I would say this, 2 days is a very long time in this world at the moment. We've got 2 days to go, Lisa, before we get to that Fed decision.
Hours are very long at this particular market. The fact that Max is saying, you know what, he likes banks here really shows. Okay. He has been a contrarian through and through, and here he goes.
He's sticking with it. Citi's Andrew Hollenhorst said it's about the news conference. Do they lean towards price stability or financial stability. Equity futures just about positive on the S&P. Coming up, Dan Morris of BNP.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Shares of UBS are lower after it agreed to buy Credit Suisse in a historic deal aimed at containing a crisis of confidence. UBS is paying $3.2 billion in an arrangement that includes extensive government guarantees and liquidity provisions. The price per share marks a 99% decline from Credit Suisse's all-time high in 2007. U.S. regulators are now moving toward a breakup solution for the collapsed Silicon Valley Bank. Bloomberg's learned the FDIC couldn't find a suitable buyer for the entire bank. It's looking to sell it in at least two parts. China's President Xi Jinping is making his first state visit to Russia since it invaded Ukraine. The three-day trip that begins today is a strong show of support for Vladimir Putin. Xi is likely to discuss his 12-point blueprint for ending the war. That plan has been dismissed by most Western governments. In France, President Emmanuel Macron's government faces two confidence votes as soon as today over his pension reform. Last week, Macron used a constitutional provision to push through the plan to boost the minimum retirement age from 62 to 64. That led to violent protests. Macron's government says the no-confidence votes won't get a majority in parliament. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Was going to keep rain World Cup. This is a 3
as the economic picture does.
The OK is getting ready to make a decision.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of a trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. After a week of turmoil, what's the Fed's next move?
The job of reducing inflation is not over.
Are they worried about the signal it would send if they did nothing?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Central banks groping their way through a dark room looking for Schrodinger's cat.
Does this indicate that the Fed is petrified?
Does bank supervision take precedence?
If you want to fight inflation, you better sort out your financial system first.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
People are doing something that probably is not rational, but totally understandable, which is they're moving deposits. And where they're moving deposits out of? The smaller and the medium-sized banks into the larger banks. And that dynamic isn't going to stop overnight. There's going to be a lot of repricing in the credit segment. So this is going to be pretty bumpy going forward.
Certainly a bumpy ride over the last couple of weeks. That was the brilliant Mohamed Al-Arian yesterday evening weighing in on the situation with Credit Suisse and UBS and the banking scenarios that are playing out worldwide. Equity futures right now on the S&P just about unchanged. Let's whip through this for you. Yields again lower by 7 basis points on a 10-year, 335.41. On a 2-year yield down about 9 basis points, 375-ish. Going into the Fed decision this Wednesday. Will we get 25? Will we get nothing? What do the projections look like? We'll ask these questions all week for you. Elsewhere, 2 names I want to look at. One is UBS. It's recovering. It's down about 7% at the moment, but that's basically a session high for the stock. It was down as much as 16% very early on in the session. The other name we need to talk about, and I keep going back to it, it's First Republic here on this side of the Atlantic. And I keep going back to the news of last week. You get 11 banks trying to restore confidence in this name, coming together, depositing $30 billion US. The stock drops by something like 33% in Friday's session, and now it's a break of 20 in the pre-market, Lisa, down another 15.
It's a confidence game, and clearly what has happened so far hasn't restored that confidence. Now we have another downgrade, and yes, the credit rating agencies have been behind the 8 ball. They've been downgrading in real time alongside the downgrade that you're getting in market pricing. But that said, how do you then entice flows back into a bank that relies on them to execute a lot of the lending that they're known for?
With great difficulty.
Yes.
And that's the problem they've got. Did you see mid-sized banks over the weekends? If you're listening at home, Lisa and I were talking about yesterday evening, mid-sized banks basically pleading to lift the cap for deposit insurance.
And again, on one hand, that gives depositors confidence. On the other hand, why would they need it, right? I mean, I think that this is the other issue. How do you restore confidence when any suggestion of a remedy suggests a problem? And I think that that's sort of the conundrum that a lot of regulators find themselves in.
Joining us now to discuss, Gerard Cassidy of RBC, a wonderful friend of this program over the last couple of weeks, particularly as we try and work our way through a lot of this. Gerard, this is what S&P said yesterday about First Republic. This line out here I just thought was scathing. Attracting meaningful deposits will be difficult. Gerard, how do they turn that around?
Thank you for having me on the program, John. And time will turn it around, of course, but you're right. They have focused very successfully on the large, high net worth depositor. And those depositors, as we've seen with the other banks that have seen deposit flight, have been moving out. So we need to see some first quarter results. I know that's not that close. Results will probably come out mid-April, but we need to see where those deposit levels are. We saw the big banks, as you know, deposit about $30 billion into the bank last week. And we anticipate that as confidence comes back to this company, because the company has made incredible profits over the years. Its credit quality is superb, but they have the mismatch on the assets versus the liabilities, which is what everybody's concerned about.
Some people point to ongoing fear of deposit outflows or deposit catharsis, as one analyst called it yesterday, because of the discount window at the Federal Reserve and the borrowing levels rising to levels that we have never seen before, that exceed what was at the peak of 2008, one of the crisis measures. What do you make of that in terms of the breadth of the need for this capital?
It's really interesting, Lisa, because you're right. The numbers were extraordinarily high on Thursday when they were released. First Republic pointed out that they were into the window at one point for $100 billion last week. And the totals, as you might recall, were about $152 billion. So though the number was very large, I suspect that 2 or 3 banks, First Republic being one, Silicon Valley, as well as Signature, were probably the bulk of what was borrowed from the window. When we talk to the regional banks, we're seeing no evidence of deposit flight. Yes, is there some deposits leaving, but that's relatively normal. So I understand the concern, and I understand people saying, you know, the small banks are going to lose deposits. Now, the weekly H8 data, which came out on Friday, now granted, this was for the cut at March 8th, so it was before the crisis started, but deposits are up for the small banks. We'll see what happens this Friday when those numbers come out.
Given that that really goes against the common narrative right now, Gerard, do you feel that perhaps this idea of a credit contraction among the mid and smaller banks has been overstated, that these banks will continue lending as they've had because they haven't had the positive outflows that people are talking about?
Lisa, I think you're right. And I know it's contrary to what everybody's saying, but you know, the banks are lending based on the economic activity in their respective markets. We also have to remember many of the banks' loan to deposit ratios are nowhere near the highs we saw pre-financial crisis when those numbers were in the low 90% range. Many of them are in the mid 70s to low 80s, so they got plenty of room to lend if they choose to. But if we were talking about Columbus, Ohio, as you're aware of, Intel's building this new $30 billion plant. It's far different in Columbus than it is in Silicon Valley this morning.
See the numbers from Credit Suisse? Daily outflows, 10 billion a day. That was the report, 10 billion a day, Lisa.
Which was the reason why they had to come up with some sort of solution immediately, because of it just hemorrhaging clients at the end of last week.
Jared, follow the money. Where's it going, and how close are we to the likes of Bank of America and JP Morgan saying, no, we don't want any more?
No, John, it's an interesting concept because certainly the bigger banks are receiving inflows. We know that. We'll see their numbers as well as in April. The money, as you just mentioned, at Credit Suisse was quite dramatic in terms of what was coming out every day. And it's going into banks that are considered to be well-managed, high levels of capital, high levels of liquidity. And so the bigger banks, which includes the regionals, and when I refer regionals, we're talking about banks with 150 to 500 billion in size. So they're also looked at, in some cases, as big banks as well. So all of them are seeing deposit inflows in our view, but the biggest banks by far will get the most.
Two-tier banking system is a concept we've heard repeatedly over the last week, Gerard. There is a part of the banking system people are willing to deposit cash, invest their money in, another part they don't want to go near. Do you think that's the right way of looking at the banking system in America?
I think it's a little too early to jump to that conclusion, John. You may be right. If we're talking in 6 months, it might be clearer that you're absolutely right. But I think it's a little early to jump on that because, community banks in America are woven into the fabric of this country. And I just don't, expect to see these smaller banks, their commercial customers who they've known for years, who have very tight relationships with their banks, pulling all their money out because it's a small bank. We'll see, but I think it's a little too early to jump to that conclusion.
Joe, can you do us a favor? Once I've said thanks and goodbye, can you leave your shot up? Even after you've walked away.
Seriously.
Just a bit of therapy for me in the commercial breaks. You've seen this, the dog in front of an open fire.
I mean, honestly.
The sun is coming up.
It's
the
just,
open water.
You want to keep it up. I want to get it off so I don't have to rethink
disgusting.
my life. I mean, honestly, Gerard. Seriously.
Jared
Beautiful.
Cassidy of RBC Capital Markets. Jared, thank you for that. How relaxing is that?
Is it relaxing or is it thinking,
listening to the soothing words of Jared Cassidy
I know.
and just watching the fire burn in the background.
No deposit.
And then the dog walked in and that dog's not going to bark.
No,
that dog is so
not.
chill.
100%.
So chill.
A storybook right now in Gerard Cassidy's life.
Nothing chill about this market, though, Lisa. We've got First Republic down 17% in the pre-market. I'm sure a lot of people thought that the actions last week would restore confidence. Didn't see it Friday. Not seeing it this morning.
No, although off some of the lows of earlier. I don't know if we could take a signal from that. I don't think we really can. I don't know what we can take a signal from, and we're not going to come up and make up narratives. But what we are seeing is definitely fear that is pervading through the financial system. And I do think that the wipeout of those bonds, I know that it sounds esoteric, I do think it gave larger fright to what else could potentially get wiped out as a lot of central bankers and authorities try to bail out some of these banks.
So tell you what Bruce Kasman's doing right now, right this second. Running around trying to find like a Zoom.
I was just about to say, painting a background.
Just something. Just something.
Please, compete.
Bruce Kasman of JP Morgan is joining us next. Looking forward to that conversation. Equity futures right now on the S&P, just a touch negative. No drama on the S&P 500. Yields keep heading in one direction, and that's lower. Your 2-year down 7 basis points. 376 on a 2-year. A couple of days away from Chairman Powell and the FOMC.
governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
From New York City, welcome to the program. Good morning to you. Alongside Lisa Roberts, I'm Jonathan Ferro. TK is going to be back in about a week from now. He's sitting this out. Might be a good idea. Don't know. Let's see how Wednesday goes. Equities totally unchanged almost on the S&P 500. On the Nasdaq, anything but through last week, up every single day of the week. And on the week, closing higher on the Nasdaq 100 by almost 6%. Bramo, we're back to that. We're back to that in the equity market.
Again, I can't really create a narrative. At what point do people take a look at the prospect for fewer rate hikes from the Federal Reserve or even potentially rate cuts as soon as June, at least based on market pricing, and say, okay, well, that's a reason to get risk on? We just heard Max Kettner saying, you know, if you thought that perhaps things were by a month ago, why not now? Things are even better. So you do have people coming out on that side while other people are saying, we don't know what we don't know, and there's going to be a credit tightening that hadn't been foreseen and that is new that we're seeing take place.
It's in a huge move in this bond market. Let's pick up on the 2-year, the front end of the curve right now, down another 7 or 8 basis points, 376. On a 10-year, we're down about 7 basis points. On a 10-year to 335.60. Did the ECB just give the playbook to the Federal Reserve last week? Hike, as expected, then talk about the baseline. If the baseline holds, I've got no idea what the baseline is for this Fed and how much has shifted over the last couple of weeks. Euro dollar close to 107, 106.89, positive 0.2%. The Fed might say they're data dependent. Dependent on what?
On which data?
On this, on bank stocks. Take a look at UBS first. UBS, after a 3 billion Swiss franc tie-up with Credit Suisse, the stock is lower by 6.6%. I have to say it was much, much lower. Earlier in the session, we were down about 16%, so 6% lower, 7% lower off the back of this. Maybe that's a no-drama story. Elsewhere, ING, looking at European banks elsewhere, ING's down about 7%, SocGen down about 5%, BNP down 4%. I'll stay on top of that story for you. I'll stay on top of this for you too. First Republic, down 18% in the pre-market. 2 Mondays ago, this was a $123 stock. On Friday at the close, it was 23. This morning in the pre-market, it's sub 19. Lisa, sub 19.
So now the question becomes, is First Republic a specific story unto itself as it gets downgraded again and again? Or is this something that represents the lack of faith in mid-sized banks that has yet to be restored? And that, I think, will be parsed out as we watch some of the other stocks throughout the day.
What about the lack of faith in credit rating companies who had these names at IG a number of weeks ago?
Okay, not to be cynical, but was there faith in the credit rating agencies? Because they've gotten a lot of things wrong. I mean, this isn't new,
Hence
right?
my phrase, the lack of faith.
But this isn't a new sort of phenomenon here. So, okay, yeah, they're following the market and fair. But at the same time, you said this yesterday, it matters for people who actually track ratings and are forced to buy or sell based on whether things are still applicable to their indexes.
Do you think because there is so little faith in some of these credit rating companies that the language they use when things get bad, they kind of double down and make it a little bit more aggressive? because the language used yesterday from S&P, and I'll read out their quote for you. We do not view this deposit infusion as a longer-term solution to the bank's funding issues. That deposit infusion was that 11 banks getting together and dropping 30 billion into this institution. And this line right here, attracting meaningful deposits will be difficult, constraining the bank's business position. What are they essentially saying there?
I can't get in rating agencies' heads, but what I can say is this goes to the fundamental question around the business model of a lot of these companies, which is it is based on faith. It is based on this idea of confidence that they will be able to give you your deposits back when you want them. And that, I think, is the question for so many people. How do you trade around something that depends on sentiment that can be swayed by different events or different statements?
I use that phrase baseline, the base case. I've got no idea what your base case is right now, but it's certainly shifted in the last couple of weeks. There are two general assumptions at the moment, for the broader economy anyway, that the banking issues will lead to tighter lending standards, which will lead to tighter financial conditions, which will ultimately lead to softer growth. Torsten Slock of Apollo put this out, put a number on it over the weekend, which I imagine is tremendously difficult to do. Here's the number for you. He said, quantifying the impact of tighter financial conditions plus tighter lending standards, we estimate that the events this past week corresponded to a 1.5% increase in the Fed funds rate. The risk of a sharper slowdown in the economy have increased. Bruce Kasman joins us now, Chief Economist and Head of Global Economic Research at JP Morgan. Bruce, timely conversation. Wonderful to catch up with you. How difficult is it to equate the events of the last week with a shift in the Fed funds rate and a hit to GDP?
Well, I wouldn't try to touch that with any confidence at this point. I think it's, first of all, we don't quite know yet what the event is in terms of how far-reaching and how stressful it's going to be for broader financial conditions. I think the second point is that we do have a good sense that credit conditions in the U.S. will be tighter, but we also have a good sense that the path the Fed is on will be somewhat shallower than it would be otherwise. The other thing we should just recognize is, as we were coming into this event, what we were watching was news telling us not only that inflation was persistently higher, but also that growth momentum was actually healthier in the U.S. and globally than we thought. So I think it's a very complicated environment. I think obviously the risks to the downside have increased. I wouldn't go so far at this point as being able to quantify it. I don't think the Fed will either on Wednesday in terms of making its decisions.
So you didn't have much of a weekend either, Bruce. I assume that you've been on calls for the past 48 hours pretty consistently with all of your clients and all of your peers trying to understand what is transpiring. What did you tell people? Where was your conviction as you fielded all these questions?
So I think part of my conviction was not to be confident here and not to understand the event at this point. We've increased the tail risk to the downside, but we should recognize again that the Fed is going to do less, that while credit conditions are going to tighten, monetary conditions are probably going to prove to be easier. And also to understand, again, that the economy has come into this with somewhat greater momentum than we in the Fed had expected. Again, I think the risks are to the downside. The other point I just make is that unless we're in the midst of an outright crisis where credit conditions are seizing up, this event of tighter credit is likely to play out over months and quarters. It's not likely to hit us like a truck over the next few weeks.
Okay, given that, what's your concern that we're going to see an ongoing heat in the inflation data, that the economy is going to have so much momentum that perhaps we have underestimated how much that inflation can be persistent as we all talk about the disinflation of a credit tightening that hasn't happened yet?
So, our view has been that inflation is coming down this year, but it is not going to be sufficient to be satisfactory to the Fed. And I think that's what we're tracking in the numbers. I think if you have a recession starting anytime in the next 3 to 6 months, that's going to do a lot of the Fed's job. So even if inflation stays high, you're going to see the Fed ease. If you don't have a recession and we continue to have inflation holding elevated, I think the risk that the Fed, even if it pauses in the next few meetings, that it has to come back and tighten again is still there, and we shouldn't ignore that.
So, Bruce, the cuts we're pricing right now, you'd fade that?
Well, there's a risk here that there's a financial crisis going on. There's a risk, a more elevated risk we slide into recession. If that happens, the Fed will ease, and the Fed will ease as much, if not more, than what the market is pricing in. But right now, I would not put that as the only scenario that can play out. And I think if we don't go into recession in the next few months, the Fed's not easing. I think we have to realize that the case for the Fed easing is on the back of either a financial crisis or sliding into recession.
Just how big do you think, Bruce, is the secular component to the inflation story?
I think there's a loss in terms of supply in the U.S. labor market. I think there's shifts that have gone on in supply around the world that's different, and I think those will add secularly to inflation. And I do think psychology has shifted. I don't think if we would kind of try to figure out where underlying secular inflation is, we'd have a number higher than somewhere in the mid threes or close to 4. But I don't think it's as low as 2, which is where we were averaging before the pandemic shocks hit us.
We flirted with the political aspect of the Federal Reserve and what that means for a fight against inflation that you think is going to be a bit higher than it had been pre-COVID, what we just experienced over the past 3 years. I'm curious at this point, especially with all the pushback from Congress, with the oversight, the lack of supervision of Silicon Valley Bank, this potential question around how the Fed responds to both that and inflation that is their priority. What do you think is the likely political read-through of some of these actions? In other words, how compromised is the Fed in their mandate?
I think the Fed still has all of the independence it needs to act here. There is political influence, I don't doubt that. But I think the Fed will more likely than not move 25 basis points on Wednesday. I think that's a relatively clean decision, which is weighing the stresses that we're facing here with the continued sense that they've got to fight to contain inflation. I think going forward from here, they'll probably say, let's wait and see this. I think the guidance this week will be very open as to what happens next. And I think we'll see where we are in three or 4 months. If the economy's in recession, they ease. If the economy's not in recession, inflation is still well above 3%. I think the Fed's going to be tightening later this year. And the risks have clearly shifted more in the direction of a recession, but not, I think, at this point, decisively so.
So do you think that Jay Powell is Arthur Burns or Paul Volcker?
Well, let's hope neither, for our sake.
Hey, Bruce, you've got to leave it there. Bruce Kasman at JP Morgan. Bruce, wonderful. And thanks for being with us this morning. Bruce Kasman with a tremendous backdrop too, just to throw that out there, just in case,
Wait, you want to make sure he comes back? Is that what you're saying?
I asked this question yesterday and did so through the whole of last week as well. Never mind Burns and Volcker. Trichet, hiking rates into a crisis. Oh, wait, the same again in 2011. Is that the risk they run here?
They run every risk. I mean, what we just heard from Bruce Kasman was a complete lack of certainty with anything, right? I mean, that's essentially what we hear from everybody, this sort of humility and honesty that this is so greatly uncertain with an incredible binary potential duality of outcomes. You have on one hand the potential for a sooner recession. On the other hand, the recession gets pushed off because the Fed doesn't do as much. And then the Fed, yes, perhaps eases, but then has to retighten. The sort of question around the Arthur Burns reaction to what we saw in the 1960s. 1970s.
Mohammed talked about some of this in the FT this morning, the big challenge, the trilemma for Fed policy, the conflict between all these different things, financial stability, price stability, making sure that you don't absolutely bludgeon the labor market. That's all conflicting, coming together at a difficult time for Chairman Powell.
What I would like to hear, Gerard Cassidy actually I thought was fascinating. He came out and he said he is not seeing deposits get withdrawn from some of these mid-sized banks. If you had transparency on that front. If you had someone come out and say, look at all of this. This is just truly an idiosyncratic issue. Look at all of this, books open, then maybe the Fed could raise rates by 25 basis points, hold, try to understand more, and we can move on.
I think the I word is increasingly difficult to tolerate.
Yes, I would agree with that.
Idiosyncratic. To sit here and say every single weekend after a bank has effectively failed, that we've got to keep calling it idiosyncratic.
Well,
how many banks do you need to just say, actually, we've got a broader problem here?
Perhaps we just need different language. How many are there of the weaker players that potentially could be susceptible to a similar type of activity? Maybe that's more fair.
Equity futures slightly positive on the S&P by almost 0.2%. Jens Nordvig of Exante Data joins us next.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Central banks worldwide are endorsing Credit Suisse's rescue after UBS agreed to buy the Swiss bank for $3.2 billion in a government-brokered deal. U.S. Treasury Secretary Janet Yellen and Fed Chair Jerome Powell welcomed the news and said that capital and liquidity of U.S. banks is strong. Both the European Central Bank and Bank of England also endorse the actions taken by Swiss authorities. A unit of New York Community Bancorp has taken over Signature Bank's deposits and some of its loans. Signature collapsed earlier this month. Its 40 branches will operate as locations of Flagstar Bank starting today. As part of the deal, the FDIC gets equity appreciation rights in New York Community Bancorp common stock valued at up to $300 million. Donald Trump's claim that he'll be arrested Tuesday has Republican Party leaders rallying to his side. The former president wrote on social media that he expects to be arrested as part of a New York investigation into his hush money payments to an adult film star. He urged his supporters to protest. The European Union is set to agree on a plan to send Ukraine 1 million artillery rounds over the next year. Foreign and defense ministers are expected to reach an agreement today. They'll also approve spending more than $1 billion to reimburse EU members who send Ukraine shells from their own stockpiles. Global news, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
Markets are hunting, right? And so it's looking for any weakness across financials. And so whether it's rational or not doesn't really matter. This has a tendency of taking a life on its own, and that is where we're at right now.
I had a guest on the program last week say it was seek and destroy mode. Seek and destroy. Make it sound brutal, don't they? That was Greg Peters of PGIM yesterday evening on our special coverage of a deal between UBS and Credit Suisse for $3 billion US. Equity futures right now slightly positive by 0.1% on the S&P. All eyes on UBS trading over in Switzerland. It was down hard around the open. It's now down about 4 or 5%. So recovering there still as the day progresses. We'll keep an eye on that. Another eye on this one. First Republic is down 17% in the pre-market. I might add, Lisa, that this is becoming problematic given the hopes that we had a solution last week to restore confidence.
Well, that's the key issue. The declines on top of all of the measures that have already taken place. And yes, we're asking, okay, well, where does it end? But it also is, what do regulators, what do some of these officials have to do if all of the measures they've taken so far haven't been enough?
Jens Nordvik joins us now, the founder and CEO of Exante Data, as well as Market Reader. Jens, wonderful to catch up with you, sir. The developments overnight, let's start there. What did you make of that tie-up and ultimately the fallout in certain parts of the debt market?
So we knew that Credit Suisse needed some form of rescue, right? And UBS had been in the headlines for a while, so that was not a big surprise. The surprise was that there were losses for the riskiest bondholders, right? So it is a long time since we have seen something like this. And we've seen a repricing of risky debt, high yield debt in Europe is a lot wider in spread this morning. So the question is whether that's a repricing, just to kind of, we need to reset, or whether we move on to different banks and it doesn't stop with Credit Suisse, right? So I think that the difference to 2008 is that in 2008, we had the entire banking system loaded with mortgage bonds that we couldn't value, right? And this occasion, it's more a liquidity issue. Certain entities have serious liquidity issues, but we don't have the same kind of asset losses that are hard to quantify. We obviously have losses on bond holdings for sovereign bonds, but those are very easy to value. So that's the difference. And we'll really have to watch whether there is a next shoe to drop here, or whether the European banking system is now actually starting to look a little bit more resilient than the U.S. system, which is impacted by obviously the regional issue that is specific to the U.S.
Do you buy that? I mean, Jens, we're not seeing that necessarily in the market activity this morning in terms of just how much certain European banks have sold off. But do you think that European banks are a better buy and a better sort of more optimistic approach than the U.S. banks right now? Is that correct?
So I think we have in Europe more concentrated banking systems where it's typically 2-3 big banks in each country that account for most of the assets. And in a way, in a situation where it's good to have implicit government backstop, that's a good thing. Whereas in the US, we have this very fragmented banking system where half of the assets are within the smaller banks, right? And we don't have any explicit backstop. In fact, the Dodd-Frank regulation made it very clear that we're not supposed to have any backstop of that nature. So there's a difference. And I think also in terms of deposit dynamics, right, we clearly have sort of erratic deposit dynamics in the US, as we could see in the Fed data last week. And in Europe, that's a little bit different. I don't think we've seen that yet. So there's a difference. But obviously, the confidence shock that has come out of Credit Suisse, we need more time to assess whether that was really specific to Switzerland or whether it's something that's going to migrate into the Eurozone banks as well. And so far, the jury is out, right? We've had a repricing today, but investment-grade credit is actually coming back now in the last couple of hours. And I think that's worth watching very, very carefully.
When we talk about nodes of contagion, you were talking about the contingent capital bonds. Bob Michael of JP Morgan Asset Management yesterday was talking about who are the holders of these bonds, who are going to be taking down some of those losses, pension funds, foundations, big institutions that then are going to reduce risk elsewhere. What's your view on that as a potential node to watch?
Yeah, I think that's really important, right? So that's exactly why I have, all those credit indices at the top of my screen today, right? So we can see everything in the risky part of the credit structure got repriced down. Totally logical. That makes sense. And then if you look at IG credit, where you can really worry, okay, we're going to have contagion into that space as well. We were down a lot a couple of hours ago, and now we're coming back. So if IG credit is holding up, i.e. the contagion is sort of really limited to the most risky part of the capital structure, that actually is a source of resilience. So that's what we have to watch today. Does that hold up? And I think you can also see within the bank stocks that it's really the riskiest banks that are seeing some tension, and the other ones, the higher grade banks, are actually starting to come back as well. So it's a quite nuanced picture here, and we have to also separate what is the liquidity situation that can be addressed, what are underlying solvency issues, right? And don't forget, European banks have been trading the best in years, up until the Silicon Valley bank problem, right? So it's a very different situation from the Euro crisis, for example.
So Jens, this financial instrument we're talking about, this security, the convertibles, this was an important tool to attract capital, to raise capital for the banks, and ultimately restore confidence in the European banking system, to make sure everyone understood they were well capitalized, et cetera, and at the start of the year, to your point, Jens, this was meant to be the real reset for the European banking story. Higher rates, a better economy, a better story, flows start to come back into the Eurozone, investor flows in a more material, pronounced way. Jens, there was an FX call associated with that, and I wonder how that's reset for you.
So I actually would stress that the biggest change in capital flows in Europe is that we used to have 0 or negative rates in Europe, and we had a steady flow out of Europe into global fixed income, EM, and the US. with interest rates now 3-4% in the Eurozone, investment managers in the Eurozone don't need to go abroad to get fixed income exposure. So that's the big change, that money can actually stay home. And obviously, we'll see what the ECB does in coming months, but if they continue to raise rates, that effect will become more and more powerful, and that will in itself be Euro supportive and could be negative for the other places where that money used to go. So that's a key thing to watch, and it could be super important for the euro.
So euro dollar establishing a new floor. Are you thinking about a higher ceiling? Jens, how do you think about that?
If we can avoid continued banking instability, the ECB will continue to go. They've said so over the weekend even, right? So that's the path that they want to go down. We'll see if the market allows them to. But if they continue to go down that path and we don't have like severe instability, that could be a source of support for sure.
So Jens, when they say data dependent, do they mean the price of bank stocks?
Well, they put it in very explicitly in the wordings, right? So there's no doubt that we essentially have, okay, we watch the growth, we watch the inflation, and we watch what's going on in the financial sector, right? So those are the three dimensions, and that's what is new over the last couple of weeks.
Monetary policy is now bank stock dependent. Jens Nordvik there of Exante Data and Market Reader. Jens, wonderful. Thank you, sir. That's where we're at, going into the Fed. And if you believe we're bank stock dependent, then 2 days is a long time in this market going into that Fed decision.
We were bank stock dependent right now. We were University of Michigan sentiment survey dependent a bit ago. We were
Wasn't
JOLTS.
that ridiculous?
We were JOLTS survey dependent quite a bit ago. It's a moving target, and I think that's what makes it so difficult. Data dependency is a bit tricky to get your hands around when the data keeps switching in terms of the importance of it and the frequency of it.
It felt easier when it was about you, Mitch, and leaked stories to the Wall Street Journal. We're going to go big. Didn't it feel easier back then?
I mean, maybe, but they weren't getting it right. I mean, honestly, they still missed a number of different things. Right now? Well, that's a good question. I don't know. I wonder, as Jens was talking, how much does the euro rip if we see the Fed hold rates where they are on Wednesday after the 50 basis point rate hike from Christine Lagarde last week?
It depends why you think they're holding rates. Does that spook people? Is that a global contagion story where people start to get worried?
You sound beleaguered right now.
The reason I ask this, and I know that smart people say that's not how this is going to work, that's not how these people think. We reported last week that's precisely how the ECB went about conducting policy last week.
I don't think anyone would at all question why you would say that, because everyone knows how much this is a game of psychology. What I would say is it seems like right now there is an unknown about how the market responds even to the central bank moves. And you were saying, it depends on why. There's sort of a beleaguered sense of, even if you know what they're going to do, who knows what the market response is going to be and how it's going to be taken and played out in the market. I mean, they're dependent on something that's dependent on them and on psychology. This is just a cycle.
Yeah, you'll drive yourself nuts trying to work this out.
Yep.
UBS is improving. It's down about 4% in early trading over in Switzerland. It was down a lot harder than that around the opening bell. The other name to watch at the moment is First Republic. That's down about 21% in the pre-market, down 21% after falling 33% on Friday's session. Going into the close, so we trade in at around 18 in the pre-market on that name. Dan Morris of BNP Paribas is going to join us next with equity futures on the S&P 500. Looking a little something like this, positive, 0.1%.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Chris, can I ask my landlord for a rent cut in the next couple months? Like, is that reasonable?
Well, I guess it depends when you signed your lease, Joe. It sounded like you got kind of one of those pandemic deals that, particularly in New York City, where rents actually fell really sharply in that first year of the pandemic. So we are really seeing the market having turned a corner a little bit over these past few months. Prices have been coming down for 4 straight months now in our national rent index. Wow. But, if you're still paying that late 2020 level, then you might not necessarily be eligible for a discount at this point.
Good point. All right, I have another question, which is like, so I have 2 kids, but unlike other people, I actually am cool, and I don't want to move to the suburbs. Like, I want
This episode is just Joe taking like advice on handling his rent.
I just want to point out, I really like my landlord.
You love your landlord?
She's very attentive. We have a very good relationship. So even though I started the episode saying I was anxious, if she is listening to this, I hope she hears that I really enjoy where we live, and I really enjoy our the landlord.
She should factor your consistency into her pricing algorithm.
We've never been. Yes, exactly.
Excellent.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
That a swift and stabilizing solution was absolutely necessary. This solution is the takeover of Credit Suisse by UBS.
This was not the best solution, but it dominated the other two, which was either nationalization or trying to wind down the bank.
The banking sector, it runs on confidence. We just need to see what the sentiment is out there.
The system is very fragile in the banking system, right? Companies are levered. I think they're well managed, but when things get exposed or moved, it moves quickly.
For sure, it's going to bring down inflationary pressures. I'm anxious to see what the Fed does on Wednesday.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Another long week coming up, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Lisa Abramowitz. I'm Jonathan Ferro. TK is going to be back next week for you. Equity futures right now unchanged on the S&P 500. Lisa, another weekend putting out another fire.
We had narrative after narrative after narrative all year. It's been one day, one narrative, next day, new narrative. And over the weekend, we took all those narratives, threw them up, and everyone's trying to grasp the one that they can still cling to as they try to come up with some sort of compass for the week ahead.
I won't give you my view. I'll just frame the range of views out there right now on UBS. UBS is down 4%, was down a lot more than that a little bit earlier in the session. Here's the less constructive view from KBW. Considerable uncertainty around the earnings trajectory. Here's the more constructive view from B of A. The logic of the deal, Lisa, quote, impeccable. The cost synergies, quote, substantial.
So here are the two sides of it. On one hand, this allows the UBS to organically grow in the U.S. This has been one of the big pushes. It allows them to consolidate even more income-driven kind of wealth management oversight as well as deposits. On the flip side, what are the unknowns that caused UBS to demand a $9 billion backstop or 9 billion Swiss franc backstop to any potential losses, wipe out the AT1 holders, as well as a $100 billion liquidity line from the Swiss National Bank, raises some questions about what they saw under the hood.
Oh, to be clear here, if you knew that they could get the Swiss unit for $3 billion, you'd be like, wow, that is some deal. How much time did they have to do due diligence on this? We understand, based on what we're told, is that talks really started to get going on March 15th. then really started to accelerate through the weekend. Goes to your point, there's so much we don't know about what's under the hood once you lift the lid on the bank and how much work there is to do to integrate it.
And this is going to be 3 to 4 years of integration. And you heard UBS say to a lot of their workers, we're still competitors with Credit Suisse. I mean, there still are so many questions right now as you try to parse through what this means. So when you take a zoom out as far as does this stave off the contagion, we don't even know what the problem was that required such a quick response. Yes, we know it was deposits that were outflows from Credit Suisse, but beyond that, what else is going on?
Whenever there's a crisis, you throw around an acronym. So the new one that people are throwing around, AT1. AT1. What happened yesterday and why is it so important?
These are contingent capital bonds. It's a $275 billion market that was intended and grew out of the financial crisis to be bail-in bonds. Basically, they would be the first loss types of bonds as you saw banks hit their capital thresholds, right? What we saw yesterday is, yes, they were wiped out in this acquisition deal. But even more, and you pointed this out really smartly yesterday, equity holders are still getting something. So basically what we have learned is that they are the lowest tier on the capital structure and get wiped out before equity. And that is a game changer that's causing all of this debt in this $275 billion market to get written down in a massive way.
Well, this is what Greg Peters of PGIM said. There was always this equity-type risk associated with the instrument, and now we're finding out, no, it's actually riskier than equity in some cases.
And the Swiss National Bank, the regulator, I should say, FINMA over in Switzerland, single-handedly rewrote the rules for this entire market. So how much pushback do they get from some of the other regulators as well from Europe?
So UBS right now is down 3.7%. That improves. Over in Europe, in the rest of the banking universe right now, ING's down about 5.6%. SocGen's down about 3.5%. I wouldn't call that dramatic. I'd call this dramatic, to be honest with you. First Republic in the pre-market, down 20%, Lisa, after losses on Friday of more than 30%.
Right, raising questions about what they need to do, what they need to see in order to stave some of the flight of investors, at least, if not depositors. We're watching a number of things today, but really there are only two themes. It's central bankers and it's what happens in the banking complex. 10 a.m. we hear from President Christine Lagarde of the European Central Bank. Does she give some nod to what we have seen with UBS and Credit Suisse, to the potential concerns around what happens in other banks? Today we have an incredible lineup, including Bill Dudley, former head of the New York Fed, Michael Arrighetti of Ares Capital, a co-founder and CEO. We also have Leon Cooperman of Omega coming out and talking about what he expects at a time when there is a big question about the private market's role in all of this, as well as contagion in the private markets. And then, of course, Tuesday through Wednesday, the Fed will meet and the Fed will decide something. This is a big unknown. We don't know what they're going to decide, and we don't know how the market's going to respond. But what we have seen is a complete re-rating of Fed rate hikes. They have been wiped out of the market in terms of market expectations, and now we're pricing in cuts as soon as June, with that two-year yield declining by more than a full percentage point since earlier this month.
Markets made the call. They're done. It's making the call again this morning. Front end of the yield curve down another 7 basis points, 3.76. So we were north of 5 a couple of weeks ago. Now we're well south of 4, and we've taken out all those hikes and we're pricing in a real cutting cycle.
This is unprecedented in the speed of repricing rate hikes and rate cuts and just sort of the tumult that we've been seeing. So at what point does that in and of itself cause turmoil? I mean, if you think about how quickly some of these benchmark instruments are shifting around, you just wonder what the read-through effects really are.
It was only 12 months on the 16th from the first hike. It's only 12 months ago.
I'm dizzy.
0 to 450 and like that. Dan Morris joins us now, Chief Market Strategist at BNP Paribas Asset Management. Dan, a theme of the morning so far, and good morning to you, and welcome to the program. A theme of the morning so far for us is this theme, data dependency. Are they now just dependent on this one data point, the price of bank stocks?
Well, I think it goes broader than that, but there's another wrinkle to this, not obsession, this need to look at the data for the central banks to make the decisions. It's all the more challenging now because, as we've seen with the non-farm payrolls data, with the retail sales data, you can't always trust the data. So yes, you're waiting for the next data point, but particularly there has and will continue to be a problem with the seasonal adjustment factors, which make the inflation that we're getting something that you have to take with a little bit less confidence than you would. So certainly we care about the bank stocks, but we do have to remember that the fundamental backdrop here is too strong growth, a too tight labor market, inflation well above target, and that's what makes us think the Fed is not going to be able to do anything like the market seemed to be pricing in terms of cutting rates by June, as you mentioned.
Dan, how many times so far this year have you changed your overall parameter for what the outlook looks like and what your base cases are?
I don't think we've changed all that much. I mean, certainly the market seems to swing from one extreme to the other, but pretty much for quite a while now, the view has been that we're probably going to need a recession in order to get inflation down, at least in the U.S. Now, what's changed with the events over the last couple of weeks are the parameters, the path towards that recession. I mean, it's certainly fair to say that given the slowdown that you'll see, say, in credit lending from the banks because of the turmoil, that will slow growth, that will bring down inflation. So the Fed doesn't need to do as much as you would have thought 2 weeks ago. But we still think the end point here is a recession in the U.S. because otherwise you're not going to get the unemployment rate up high enough, you're not going to get wage growth down enough to get inflation back to target.
There's a concern that if the Fed does pause or even start cutting rates as soon as June, as the market is certainly pricing in, that the momentum that we keep talking about and the inflationary impulse that has been hotter than many people expected will get a bit carried away, and it will force the Fed to have to retrace their steps and tighten policy within the next 12 months even more. How significant is that possibility in your view?
Well, there's a couple scenarios. I mean, certainly one is we've already kind of seen this renewed overheating scenario, which is what led the previous increase in Fed funds expectations. And of course, we were talking about 6% not that long ago. So certainly a cut in rates, you could see having one of two effects. One, ultimately, it's going to stimulate growth. It would stimulate inflation. And you're right, would you have to retrace it? On the other hand, the risk that would seem to suggest, my gosh, there really is something very bad going on. Why else would the Fed cut? So you would think from a confidence point of view would certainly be a consideration for the Fed. So between the worries about confidence and then, again, fundamentally the need to slow growth above and beyond what we're going to see with what's happening with the banks, it would argue that really they should continue to hike.
Dan, where does this leave this NASDAQ trade? Up every single day last week with the exception of Friday, higher on the week by close to 6%. Dan, where does it leave that trade?
If you compare the performance of the U.S. and the European equity market, people have pointed out how U.S. equities have done so much better, but it's really only because of the performance of the tech sector. Every other sector between the U.S. and Europe have performed pretty much in line. So you've had a big boost to the valuations for tech stocks because the decline in discount rates, because of this decline in policy rate expectations, essentially the reverse of everything that happened last year. So that's what pushed up the valuations and helped the stocks to perform. But fundamentally, we don't think the view that the market has about the path for Fed funds is the right one. We think it's going to have to go back up, which would suggest a lot of what we've seen is simply going to unwind at some point.
Dan Morris of BNP. Dan, thanks for that. Not the only one who thinks maybe this rate pricing has gone too far. Think about where we've been so far year to date. Lisa touched on that. You alluded to it. We priced in cuts. We priced out cuts, priced in hikes, priced in something close to 6% at one point as a terminal rate. People were discussing that. And now we're pricing in cuts again and basically saying the Fed is done. We've seen the peak and cuts are in our future.
This is unprecedented. I really can't stress that enough in terms of the pace of the ups and downs with respect to pricing in and pricing out rate hikes and rate cuts, and it highlights the complete uncertainty. At a certain point, you have to wonder at what point people say, look, if you're pricing out cuts, it's for a reason. And it's for slower growth, and that's going to hit all companies. And you're not necessarily seeing that narrative take hold in markets fully yet, this full uncorrelation that we used to see back in the day.
I couldn't agree more. Not all cuts are created equally. If it's because of immaculate disinflation, wonderful. Buy whatever you like. Things are looking good. I get it. I get the argument. We go something like that. If it's because people think things are breaking, there's evidence they are, that's not good, is it?
Especially for capital creation, especially for some of the riskier aspects of the market that got inflated from lower rates. This is a different lower rate regime if rates are cut than, say, 3 years ago when it was done to just fuel ongoing free money that a lot of people got used to.
UBS improving as the session grows older. UBS is down about 4% or so. First Republic in pre-market trading, not improving much at all. We're down about 18%. On First Republic in the pre-market. Keep an eye on that, 1888. Coming up in about 20 minutes from now, we're going to catch up with Bill Dudley, the former New York Fed president and Bloomberg opinion columnist. That conversation coming up shortly.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Shares of UBS are lower after it agreed to buy Credit Suisse in a historic deal aimed at containing a crisis of confidence. UBS is paying $3.2 billion in an arrangement that includes extensive government guarantees and liquidity provisions. The price per share marks a 99% decline from Credit Suisse's all-time high in 2007. U.S. regulators are now moving toward a breakup solution for the collapsed Silicon Valley Bank. Bloomberg's learned the FDIC couldn't find a suitable buyer for the entire bank. It's looking to sell it in at least two parts. China's President Xi Jinping is making his first state visit to Russia since it invaded Ukraine. The three-day trip that begins today is a strong show of support for Vladimir Putin. Xi is likely to discuss his 12-point blueprint for ending the war. That plan has been dismissed by most Western governments. Bitcoin rose to the highest level in 9 months. The largest digital asset went over $28,000 for the first time since June. Bitcoin is up almost 70% this year. Analysts say the rally is due to the turmoil in the banking industry, higher than expected inflation, and hopes for a dovish Federal Reserve. And a group representing Uber, Lyft, and other app-based services is raising concerns about President Biden's choice to head the Labor Department. The issue is over Julie Su's stance on worker classification rules. The group wants Su to explain how she would implement a rule that could make it easier for workers to be considered employees rather than independent contractors. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
After a week of turmoil, what's the Fed's next move?
The job of reducing inflation is not over.
Are they worried about the signal it would send if they did nothing?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Central banks groping their way through a dark room, looking for Schrodinger's cat.
Does this indicate that the Fed is petrified?
Does bank supervision take precedence?
If you want to fight inflation, you better sort out your financial system first.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
Remember, the Federal Reserve Bank and Jerome Powell are ultimately responsible for the oversight and supervision of these banks. Jerome Powell has said that all he wants to do is lighten regulations on the banks. I opposed him as chairman of the Federal Reserve Bank precisely for that reason.
Senator Warren there speaking on CBS over the weekend. Now, I think a lot of people like to take a dig at Chairman Powell, but this line right here. He said that all he wants to do is lighten regulations on banks. I mean, I don't remember seeing him say that or hearing him say that.
Come out and say, all I want to do
all
right
I want
now
to do is
is
lighten
just
regulation on banks. Now,
okay.
That's not to excuse him from everything else that's happened.
All right, she's
over the
overstating
last couple of weeks.
Let's
of course.
be very clear.
Well,
She's
politicians
completely
tend to do that.
Yes, exactly. There are some questions about Randy Quarles in his role as the head of supervision for the Federal Reserve and what didn't happen, particularly with Silicon Valley Bank. And there are some real questions that need to be unearthed. My question is, how much does that complicate the Fed's role that they're trying to execute now in terms of political interference and political questions? And that really, to me, is a main question, as Jerome Powell clearly wants to fight inflation, but also not undermine the financial system.
Well, let's park the political digs just for a moment and think about policy. The senator from Massachusetts was asking the right question about FDIC insurance, whether we should just get rid of the cap, whether it should be $1 million, $2 million, $3 million. These are questions we need to answer pretty quickly.
And then decide how much banks have to pay for that insurance, right? I mean, that was something else that Elizabeth Warren was talking about. If you have, say, $2 million of protection, what's the right risk premium? Because essentially, otherwise, you have just the taxpayers of the United States holding the bag yet again. So how do they ensure that that's not exactly what's going on here?
Square this circle for me. How can you say it's not a bailout or tax-funded in any kind when we know what's going to happen here? The consumer's going to bear the cost.
The only way to do it is to charge enough of a premium to some of these banks for that insurance. But if you do that enough, then it reduces the business case for them and it crimps the lending to a lot of the smaller businesses and a lot of the individuals. So really, this is a difficult one, and she's trying to make it simple. It is not simple, and a lot of people are going to be hashing this out.
Let's work through the price action. Welcome to the program. Equity futures down about 0.1% on the S&P 500. The bond market set up as follows, down 9 basis points at the front end. Let's call it 375 on a 2-year yield, backing away there again, 2 days out from Chairman Powell. 2 names to watch in early trading. I'm looking at UBS, down about 5.5%, recovering from the losses of this morning at the open in Swiss trading. That stock was down 16% at one point. That's brutal. Elsewhere, this is brutal. First Republic down another 19% after the big move lower on Friday, down more than 30%, down another 19 to 18.73 in the pre-market. We're struggling to restore confidence in some of these names, aren't we, Lisa?
And that's probably going to be an ongoing problem. We don't know what the problem is that regulators are trying to fix. I think that's really the key, because if this is a crisis of confidence and they keep coming out with more measures, well, what are they seeing that we don't know? And I think that was really a question with the UBS Credit Suisse tie-up.
You know what was staggering to me over the weekend? Just the silence from the Treasury, just a lot of quiet from the administration. Did you notice the same thing?
Until last night when they came out and said, we're so grateful that they came up with some solution. What else are they going to say? And then say, we're going to open up swap lines to prevent, potentially some sort of shortage of dollars. But you're right. What are they going to say?
And that's the difficulty. What can you say? Let's talk about policy. AMH down in Washington, D.C. Anne-Marie, welcome to the program. As always, good morning. Walk me through the policy effort this week. What does it look like?
Well, John, also speaking of what you were just mentioning about basically the quietness we've heard from Treasury and the Fed, the statement they put out was 3 sentences long. And one thing they spoke about in this statement was that they see this resilience in the U.S. banking. This week, there's going to be a lot of questions on Capitol Hill about what went wrong, starting with the collapse of SVB. You already heard from Senator Elizabeth Warren. She wants to go down the regulatory path. We've also heard from Patrick McHenry. He's the chair of the House Financial Services, alongside the top Democrat on that committee as well, Maxine Waters. They put out a statement on Friday talking about the fact that there's going to be a hearing on all of this starting on March 29th. There'll be more hearings to follow, but they will be starting with the FDIC chair as well as the vice chair of supervision at the Fed, Michael Barr. A lot of questions about, was this a regulatory issue? Should there be a rollback of what happened in terms of Dodd-Frank in 2018? Or were some regulators potentially not paying enough attention? And that really is what you heard from Elizabeth Warren when she was going after the Fed chair, Jerome Powell.
To be clear, in 2018, there were both Republicans and Democrats who voted to roll back some of the measures for smaller banks. Republicans, though, have been the party of deregulation for a while. That has been the reputation. Have there been any Republicans that have come out after this and said, we think that more regulation is in order?
No, what you'll be hearing from a lot of Republicans and also a lot of Democrats as well is that they want to first have an autopsy of all of this. They want all their information before they start throwing around this idea of legislation. Also, they all know that it's not possible in this divided government. You have the Senate controlled by the Democrats, the House controlled by the Republicans, and Lisa, you make a great point, which is the fact that 17 Democratic senators voted to roll back Dodd-Frank. I'm talking about individuals like Chris Coons, Joe Manchin. These people also still have their Senate seats today. And then there was 33 Democrats in the House. When the President of the United States, then, former President Donald Trump, signed this legislation, he called it a huge moment of bipartisanship and something he wanted to continue. So don't think that there's going to be regulation and legislation for that. But a lot of Democrats will use this, obviously going into 2024, as a rallying cry. But then you have, on the other hand, the Republicans are going to be using this, saying that they're going to attach at any moment they can the word bailout with the Biden administration.
We were talking earlier about the FDIC insurance cap and some of the questions around what legislation would emerge from that. Is there real discussion around what that premium should be that banks pay for deposit insurance and what the cap should be? Is it $2 million? Is it $3 million?
Well, this is something Senator Elizabeth Warren wants to look into, as well as others, because right now what you have is the FDIC basically saying all deposits are insured on just these certain banks. But it has set this precedent. So now this is a talking point of whether or not this needs to be adjusted. And to Senator Warren's point in that interview, she was saying the discussion is, what is that threshold going to be? When the FDIC invoked this measure, it was because of systemic risk. And that is something we heard Secretary of Treasury Janet Yellen say in Congress. So if there's systemic risk, is that when the FDIC is able to lift that limit? But this is something that's going to be a talking point, and potentially this could have bipartisan support, because no lawmaker wants to go home, tell their constituents, especially small businesses, which keep much larger payroll capital, higher than $250,000 limit in their banks, that they don't want those funds to be uninsured.
So, AMH, just to be clear here, the conversation is now what the cap should be, not whether we should have one or not. Where is that conversation?
Yeah, I think it's a little bit of both. I think it's one, did what happened with SVB and lifting this threshold and making sure that these insurance deposits, that individuals get their money back. I think that that has led to this discussion of why do we have a cap? Should we have a cap? And if we were to have a cap, does the limit need to be lifted?
AMH, down in Washington, thank you. Following those comments from Senator Warren over the weekend, Senator Warren certainly not alone, Lisa, on that front.
No, and a lot of people are saying this is really the only answer, especially given that there has been some sort of implicit guarantee that can't be removed now, right? I mean, basically, policy written down, codified by legislation has to follow what effectively has been the de facto policy put in place by what we heard from Treasury Secretary Janet Yellen and the FDIC last weekend.
UBS looks like this morning. Good morning to you and welcome to the program. If you are just tuning in, we're down about 4.7% on UBS. Elsewhere, First Republic still lower by 18%. Another downgrade from Standard & Poor's after the downgrades we saw last week from Fitch and Moody's only a number of weeks ago. This was rated investment grade, and now it's junk by all of them. Equity futures on the S&P 500, equity futures just about unchanged, and the bond market doing its thing. Its thing currently is just to rally and send yields lower by 8 basis points on a 2-year. The 2-year 376 on a 10-year. Let's call it down 7 basis points to 336. A couple of days away from Chairman Powell. The look ahead up next with Bill Dudley, formerly of the New York Fed.